Okay, good morning, everyone, and welcome to day two of the conference of the Dubrovnik Economic Conference. Let me, at the outset, thank the Croatian National Bank for their hospitality and a beautiful dinner yesterday. And it's also important to gather at the moment when Croatia will take its full place at the European tables, and Boris, the governor voice within the ECB Governing Council, will bring the regional perspective to the heart of European monetary policy making. So this morning we have two papers, and I was trying to figure out why they belong together. The first paper from Maurice Olaric, entitled "The Safety Net, Central Bank Balance Sheet and Financial Crisis," asks one of the oldest questions in central banking. When a financial crisis hits, should the central bank step in to provide liquidity or stand back? So Bagayot debated this in 1873. Drawing on central bank balance sheet across 17 advanced economies, going back to the 1600s, the paper of Maurice will give us a long historical view on central bank safety net across the advanced world. And this question is, I think, quite timely, as is the question of aggressively to normalize the balance sheet and what the limit of central bank role as a safety net should be, is back, I think, at the center of the policy debate. So I will leave Maurice to give us a finding. And we are also fortunate to have Professor Thorsten Beck from the European University Institute to discuss the paper. The second paper will bring us to Europe and to the current challenges of Europe. Can European government manage its debt sustainably, given the pressure now bearing down aging population, defense spending, and the energy transition? Professor Zero Darvas will try to combine the state-of-the-art debt sustainability analysis and try to ask the question whether Europe fiscal rules are actually working. So the paper will be discussed by Era Dabla-Norris from the IMF and Deputy Director from the Fiscal Department. So what connects these two papers and what I think they are in the same session today? I think the deeper question that I hope that we will discuss during the discussions is how these two safety nets interact. If market believe that the central bank will always backstop sovereign debt, the incentive for fiscal discipline weakens. And if fiscal position deteriorate, the pressure on the central bank to intervene will grow. That loop is, I think, we'll argue, is a key vulnerability of the financial architecture on both sides of the Atlantic. So this is a context. So let me welcome Maurice Olaric to present this paper for 16, 17 minutes. And thank you for being here. Over to you.
Thank you, Mark, and thanks everyone for the organizers for having here. It's fantastic to be back, and it's beautiful. And thanks to all of you for making the effort to be here on time despite the activities of last night. I appreciate. When Paul Wachtel asked me to come here and present a paper, he said, bring something that has a big sweep of history, an important topic, and something that also speaks directly to the personal beliefs and experiences of the many policymakers in the room. And voila, this is the paper that has both centuries of history and a very important role for policymakers and governors in tackling an age-old question in central banking, namely, what are the effects, benefits, risks of central bank liquidity interventions during crisis? I should say this is not my work. I should even say it's not primarily my work, and my co-authors have done a lot. This is joined with Neil, who most of you probably know, Martin, who's a former student and now an assistant professor at Bocconi, and Paul, who is in Boston. Okay, let's jump right in. I'll be quick on this. Mark has given me 16 minutes, and I've already used 2. So you know the context. Central banks have repeatedly and very actively and in sizable quantities intervened and given liquidity support to the financial sector, used their balance sheet in the global financial crisis, in the pandemic, etc. And there is, whenever that happens, you can set your alarm clock. The next day, there will be an article in the Financial Times or somewhere highlighting an age-old controversy about these interventions, namely, this is good because it prevents, inefficient run equilibria. It cuts short sort of the Diamond-Dybvig cycles, if you want to think about that as a framework. So it supports and it prevents worse outcomes, versus someone will be quoted saying, well, this is moral hazard and we shouldn't reward excessive risk taking. And there is actually a positive side of letting sort of over leveraged or liquidity constrained financial firms go under. And I mentioned the historical side. This obviously goes back to Badger, Thornton, and others who have discussed this. So, what's the value between short-run stabilization versus moral hazard effects in the long run? So, what we're going to do in this paper is we're going to use the long-run history of central bank balance sheet operations, expansions in crises, liquidity interventions, to systematically study, and I'm willing to underline this, the causal effects and of central bank balance sheet expansions in crises on macroeconomic outcomes. So this is very ambitious. I mean, you might correct me. I don't know of another paper that kind of goes into the thorny issue of causality when it comes to these. This is probably one of the most important function of central banks in the financial stability realm. So we have what we think is kind of a clever way, and I hope to convince you that this works for you too, to identify causal effects. So what we're going to do quickly, long-run data, you notice policy balance sheets and their drivers. And this is now where we get to this sort of the intellectual core of the paper. We're going to argue that governors have stand-in traditions of history of thought traditions about the advisability of emergency lending in crises. And this is not going to be a black and white. This is going to be a shades of gray argument. But there is a long sort of arc of intellectual history of schools of thought about monetary policy that emphasize the dangers, the moral hazard concerns of too much activism, and especially sort of non-rule-bound activism, discretionary interventions in crisis, versus a school that is more, so if you think about the Hankey-Badger debate in the 19th century, the real bills doctrine in the early 20s and in the interwar period, the liquidationists, but you can go all the way, and I will show you this too. So second half of 20th century's monetarists, the Meltzers and Brunners of this world, who are also very skeptical of this, again, always with the argument that financial sector will anticipate this, and you get into all kinds of moral hazard dilemmata. You have to run faster as a central bank just to stand still, because you encourage that risk-taking by bailing, essentially supporting over-leveraged institutions. So what we're going to show is that governance ideological predispositions, which we're going to be, going to do like a very detailed work on trying to pin down where each governor falls into these histories of histories of thought, that they actually predict behavior in the crisis, how quickly if at all, and how quickly central banks come to the rescue and provide liquidity support. And when we say, well, this is nice because this gives us an instrument to causally estimate the macroeconomic effects. I'll come back to that. So I'll skip this. There's lots and many people in the room. First of all, let me give you some of these historical data. This is the data set. So it's kind of the usual suspects of the Atlantic economy plus Japan. And you see the coverage. So we include some of the early proto-central banks, but most of the actual analysis is done on sort of the late 1800s to until today. This is the long-run evolution of central bank total assets relative to GDP. You've probably all seen a version of this in the course of the last decade or two when we had these large balance sheet expansions. The central bank total assets relative to GDP, you see this is quite unprecedented in the long sweep of history. There's always, and I mentioned this, there was an earlier version of this paper that we actually presented in Sintra. And there was the second chart that caused quite a lot of debate back then, which is if you scale central bank assets by the size of the financial sector, the chart looks very, very different. So what has happened in the meantime, obviously, is that the financial sector has grown very much, very strongly relative to GDP. And if you think sort of the backstop or the liquidity support financial stability role of central banks is better captured by the size of the central bank balance sheet relative to the size of the financial sector, then obviously there's also been an increase in recent years, but it looks much less out of the ordinary. You could even argue, why have central bank balance sheets relative to the size of the financial sector fall or shrunk or been so low in much of the late 20th century. Last one, if you're interested, central bank holdings of public debt in the long run. You see, we at current levels, we are where in earlier times, like in World War II levels. So that's clearly relative to GDP, again, a new development. So you scale this by high public debt. Again, things look a little bit less scary. Okay, these are the long run trends. You can look at them. So now it gets a little bit juicier in terms of the actual analysis of the effects of central bank interventions in crisis. So this chart gives you just a sort of shows over time let me call it the reasons for central bank balance sheet expansions. And then central bank balance sheet expansion here is defined as a 15% growth, asset growth over annual asset growth over 1 year period. The red bars are central bank balance sheet expansions linked to wars, something that fortunately we didn't have to think about in Western Europe for a while, but maybe now we will have to. Well, in many aspects, we have to think also about these things again. And then you see the blue bars, expansions related to financial crises, where you see in the second half of the 20th century an increase in central bank balance sheet expansions linked to financial crisis events. This is probably the best way to summarize. Maybe it gives the sort of the motivation also for this paper. In the upper chart is for wars, so it's for these different periods, sort of the industrialization periods, first globalization, the world wars, and the post-World War II period. The average effect of these events on central bank expansion probability. You see sort of in wars at least until in the 20th century, where quite predictive, high probability of seeing these 15% or more central bank balance sheet expansions. More interesting, I think, for what we're discussing here is the lower chart, namely financial crisis, where you see that for most of history, at least the 400 years we cover here, in a financial crisis, the probability of central banks expanding their balance sheet was quite low. It was actually not, you couldn't differentiate it from zero. Whereas since World War II, this is the period we look at, the probability of seeing central bank balance sheet expansions during a crisis, during a financial crisis, is quite high, is about 1/3. It's statistically significant from zero. And the argument that we make in the paper, I'm not going to go into detail here, is that this has become almost a systematic response in crises. At least that's what the data suggests. So then financial market participants would have just statistically, if you look at these data, have a reason to anticipate intervention in the next crisis as well. Okay, now coming to the juicy part of the identification. How am I doing on time, Mark? Okay, yeah, I can do that. Skipping this. This chart nicely sets the context for what's to come. Year zero is the year of financial crisis. It's coded on our JST, Jodrich-Shulerick-Taylor database. We can also do it with Barron's, Werner Xiong data, building on Luke's fantastic work with Fabien in many ways. So 2 lines showing the course of the path of GDP, log real GDP per capita through financial crises. The red dotted line is the path of GDP through financial crises without liquidity support. So when central banks did not expand their balance sheet to support the financial sector, the blue one is the path through the crisis with liquidity support. Now we'd say well, this is this is of course it looks like the crisis without support have the better trajectory. The GDP decline is sort of less severe, and we grow faster. But obviously there is an endogeneity argument. More severe crisis may warrant more support. So this is just it might get us on the wrong path thinking about causality. So what we're going to do now, what we need variation in liquidity support that's exogenous to crisis severity. And this is where these intellectual traditions, where central bank governor beliefs come in. So we're gonna go through the long history of central bank governors in these countries that are here in the sample, and we're gonna sort of using, there's also some AI and some language model in there, but we're essentially going to categorize them, saying these are governors that were ex ante more on the I worry about the moral hazard of this, and governors who were more on the, if you will, dovish side and saying, well, no, we can't, we have to keep things stable, and this makes sense to prevent these, to prevent runs and a bigger crisis in the financial sector. So the instrumental variable is going to be, we use the ex ante beliefs of governors regarding the desirability of liquidity support in crisis. We're going to use that to instrument the actual actions of the central banks. We're going to say what the governor believes has a big impact on what central banks actually do in the crisis. We're going to argue, and I think that's where you have to jump with me over an intellectual hurdle, that these ex ante beliefs of governors regarding the probability of having a crisis, it's exogenous to the severity of the crisis. If you worry that dovish central bank governors are more likely to have crises because kind of moral hazard, then the bias goes against us, then we would underestimate the effects. So I think that's a nice feature of that instrument, because that's probably what most of us would worry about. So then we can estimate the economic effects. Here's an example. Richard Koch, German Reichsbank president, 1907 crisis, said in the 1907 crisis, he refused to intervene despite pressures to do so. And he said, I want to cleanse the Reichsbank balance sheet of all non-trade bills. We refused to let the Reichsbank be a cheap source of liquidity for commerce, and with it being imperative to keep the imperial currency and stability untouched. And variants of this argument that the excess speculation, the wild manias of the private sector shouldn't make the balance sheet, the clean balance sheet of the central banks dirty, are actually a kind of a constant, with some variations, of the last 150, 200 years. So if you look at the 19th century, you have the Hanke years, the Bank of England, the Real Bill School. In the interwar period, you have the Mellon School, the liquidationists. And what it shows you here are some central bank governors that are in this tradition that we coded this way. And then in the more recent decades, many people that many of you probably know personally, and the sort of the monitors, the Brunner, Meltzer, Taylor schools, are also very critical of this. And we again say there's governors that ex ante can be where parts of these different schools of thought, and then we're gonna I showed you this. This is the whole panels in the paper. You can look at it. We ran dozens of checks. Of course, does it matter to change a few things around? But the main thing is there's a good, I think, degree of variation across time, enough variation in the data that allows us to use that instrument. Quick shot at the data, the crisis response between hogs and doves. You see hawkish governors, the red bars, and then you see after the start of the crisis, what's the probability of having engaged in liquidity support, of expanding using the balance sheet in that 15% or more way. We see that the hawkish governors, ex ante classified as hawkish. No, this is not ex post, this is ex ante, are less likely. The difference becomes significant further out, and it's that difference in the responses that we will use. I skipped this in the interest of time. This is the way we causally estimate. We going to instrument. So this is the variable. Is there going to be an annual? Is there central bank balance sheet expansion of 15% more in that year? And we're going to instrument this with the Dove-Hawk classification ex ante. You see here so I think that's reassuring a feature of this exercise. You have a dove in charge when a central bank hits. About half of the cases we see interventions, half of the cases we don't see interventions. If you're hawk in charge when the crisis hits, the number of interventions falls dramatically, and the hawks are much more likely than the doves to not use, or the doves are much more likely to use the balance sheet and provide support. So this is then the first stage. We're going to instrument the central bank balance sheet expansion with the hawkish governor. So we're going to use that. We could also use the hawkish governor classification. That gives us an instrument. So we're only going to use the variation in central bank liquidity support that's driven by these ex ante classifications, ex ante beliefs of the governors. We're going to throw in a bunch of macro financial control variables, the usual stuff, country fixed effect, and we're going to look at the outcomes. First of all, first stage, hawkish governors about 36%, call it 40% less likely to intervene. And that's robust to, including macro controls, including country fixed effects. And then we're going to use that instrumented probability to estimate the crisis trajectory of economies, the path of real GDP, CPI, money, and everything you want to know under the sun through the crisis, depending on whether the central bank actually came in and helped or not. Again, the case being this is exogenous to crisis severity, so it gives us at least a causal, let's call it a hunch of a causal effect here that we can look at. This is how it looks, and we find large difference in crisis outcomes. Now, the picture is effectively flipped. If you look on left panel, this is log money, log real GDP per capita. In the middle, this is what we looked at earlier. The crises interventions, the trajectory with liquidity injection is much better. The crises are over much faster. Again, on the price side, the deflation that is often associated with the non-intervention is not there. The outcomes overall seem much better. The same is true for real investment and stock prices. And with an eye on time, I'm going to accelerate a little bit. You might ask, is this really lender of last resort, or is this just monetizing public debt? The answer is it's clearly what we see in the data is that the doves increase the balance sheet. It's driven by an increase in central bank reserves. There's no big difference in the fiscal path. If anything, government debt rises more under the hawks because you arguably might say that the hawks, the government has to step in more. I skip that. I want to make one last point, which is, so if I convinced you with all these, and you take a look at all the other things we did to make that sort of overall result robust. If I convinced you that where we stand now, the liquidity support, exogenous or exogenous as you can maybe get, makes the crisis shorter, improves economic outcomes, has less deflationary pressures, better investment response, stock markets recover faster. We still haven't answered the moral hazard argument, because the moral hazard argument is not that this doesn't work. The moral hazard argument is that this prepares the ground for the next crisis. And if we do this almost on a systematic basis as central banks, then, as I mentioned earlier, we have to run faster just to stand still. We have to do it every time, and the financial markets will anticipate our response. And as I showed you, there's some reason to do that. So what we're going to do now is we're going to ask, are there long-term risks? Does the next crisis occur sooner? When you had when in the previous crisis, the central bank provided liquidity. And now compare these two charts. Left-hand side, last crisis without liquidity injection. Right-hand side, last crisis with liquidity injection. So it's the share of the country years experiencing a credit boom episode that then is a sort of a boom-bust episode. And just from the eyeballing the data you see for the last crisis with liquidity injection on the right-hand side, there is 10, 15 years later. Yes, 10, 15 years later, you get a kind of this cluster in the distribution of more crisis coming down. So we can formalize this. Again, we can run simple OLS, just saying, does the liquidity injection in the last crisis predict the next boom-bust episode? We do the same in the paper. Does it predict more risk-taking by the financial sector? Does it make the next crisis more likely? And the answer is throughout, also in the IV, at the end, the answer is throughout yes. So there is a moral hazard component to what's happening. Risk-taking recovers more quickly. There is a higher risk of experiencing the next boom-bust episode in this long-run trajectory. And I'm saying this because these long-run data, we'll need a lot of data to change that result, because this is the near universe of modern macro data, if you will. So that's there. But then for the doves in the room, or the self-identifying doves in the room, there's a good message. If you try to do a back-of-the-envelope calculation of the net benefits, obviously you have to think about discount rates, trend growth. In almost all of these scenarios that we look at here, the question is do the short-run benefits trump Trump is a different word in these. So do they outweigh the short-run benefits outweigh the negative effects in the future? Obviously, it depends on your discount rate, and if your discount rate is very low and your trend growth in normal times is very high, then these future crises become very costly. And then you see in the upper right corner, there is a scenario where the net effect of this is negative. But in almost all other scenarios, if you assume trend growth of 3% and a discount rate of 3%, it's very clearly net beneficial if you do sort of this big net present value calculation over many years with lots of lots of assumptions, and this is really back of the envelope, the short-run liquidity intervention is beneficial. I leave it here, and sorry if I took it a little long. Thank you.
Thank you, Maurice. So let's now go to our discussion. Thorsten, please.
Doesn't work? Oh, now it works. Thank you. Thank you very much. Of course, also for the invitation, the hospitality. I'm always happy to be back. And I'm even happier to discuss this paper by Moritz and co-authors. Yes. So, no. Okay. So, quick summary. I mean, I don't really have to do this because Moritz gave an excellent presentation. So it evaluates the effect of central banks' liquidity intervention during crisis episodes, financial crisis episodes over, well, actually not the past 4 centuries, it's only the last 150 years, but they have actually data for 4 centuries across 17 countries. The identification, that's actually very, I think actually the nicest part. So the pre-crisis beliefs of central bank governors that are responsible during the crisis. The first one, yes, large liquidity interventions during crisis periods induce a faster recovery. Number 2, yes, there is moral hazard. The future boom-bust likelihood becomes bigger, and the crisis mitigation effect outweighs moral hazard effect. No. So that's very nice, very good results. By the way, there's a very small personal element in there for me, because you mentioned this paper by Patrick Onahan and Daniela Klingebiel. Now, most of the people in the room know Patrick, of course, as the former governor of the Central Bank of Ireland. Actually, I know him first as my former colleague at the World Bank. So I actually remember when they presented this paper 25 years ago. And it was one of the first papers that looked at the effect of crisis management policies on recovery. And yeah, so we found this, I remember discussing with my colleagues afterwards, and we found it interesting, but we had the same concerns, identification. So I think this makes actually, your paper makes really a very nice contribution in this context. So summary assessment, great paper, impressive data collection and combination. I really recommend you to read it. I do not recommend you to print the paper. The reason being, there's over 100 pages of appendices. Now, this is actually good news, because they really carefully document how they have gone about what, especially like the beliefs of the governors, the crisis situations, all kind of robustness tests. So it's overall a very, very nice paper. It asks a critical question that has dominated policy debate. I put here 2 pictures. We all are probably still familiar with the Greenspan put, which is kind of the moral hazard side of things. So, and Greenspan kind of very openly said, well, I don't care about the credit boom. I'm going to mop it up once it busts. Then when the Greenspan put turned into the Bernanke put, and when Ben Bernanke basically had to do what he did, or he did what he kind of what people expected him to do. But then people refer to, well, he's an economic historian. He knows what they did wrong in the Great Depression. So that's more the other side, kind of saying, yes, we have to intervene because otherwise things get even worse. So this kind of really kind of nicely contrast these two views, the moral hazard versus the recovery argument, or the kind of helping the economy argument. Okay, so now I was not invited to just say good things about a paper, and I have to do some comments, otherwise I will not get invited next year again. So yes, careful identification, of course, I already said this. So data. You refer to gray shades, Moritz, but it is kind of, you kind of do it in a black and white way. So liquidity intervention is measured as nominal central bank assets growth of at least 15%. Why 15%? Why is it not relative to a trend in growth? Why is there no adjustment for inflation? Alternatively, instead of just saying yes, no, was there not, could you actually do the discrete measure of liquidity support, or at least buckets? I understand, of course, it might not always be as carefully measured in early days, but I think it might be, you could do a little bit more by you can call it a robustness test, or you can call it just go a little bit away from this yes or no, but a bit more of a granularity in terms of liquidity support. And actually, the same goes for credit booms. Again, there's only like this kind of argument if it's above a certain threshold. I forgot which one it was. Well, again, it depends on the trend, right? And for example, if the recovery is faster under with liquidity intervention, of course, also the credit growth per se will be higher. So that's kind of also biased it already a little bit, maybe. Similarly, central banker ideology, again, I very much see this as a very careful identification and very careful data work. But at some point, you also mentioned there could actually be three categories, right? It's more the hawk, the dove, and the pragmatist. So the pragmatist in between. So again, this is something that you might want to consider. Second, I was puzzled. So you show the non-identified relationship is a bad one. So liquidity intervention, lower recovery. Then once you instrument it, once you identify it, it turns around. What actually drives it? There might also be a difference in the coefficient. At least I saw this for the moral hazard one. Is it there other crisis management policies? I'm really like to kind of find out what actually drives that. What explains that shift, that switch from negative to positive? The other one is what drives the results? Is it across countries? Is it just some countries do it, some countries don't do it because they have certain central bank governors? Or is it actually within country variation so that you actually learn? That means maybe you were focused more on moral hazard in the early days, and then you kind of the governors learn from the previous crises, the previous governors, and then turn out and do it differently. So or is it really that some countries are permanently doomed because they just either always bail out or always expand their balance sheet, or they never do it? Which then brings me to another point. You kind of treat countries independently. And that's not on the slide. You treat countries independently. What is he going to show me? The 1 minute? No, the 3 minutes. Okay, thank you. You treat countries independently, but of course we know that crises are kind of clustered, right? The global financial crisis was probably across all your 17 countries, right? So the crises don't come by themselves. So I wonder whether there's also a connection, like a policy contagion effect, so to say, across countries in your data. And of course, also, again, a time trend over time that, again, we know that the Great Depression, many countries did not intervene during the global financial crisis, given that there was a learning effect. They did intervene. So that is another question. This is a very minor point when you showed these government expenditure and then the should be difference in government debt. It's just a bit puzzling that the flow variable doesn't really show significant difference, but the stock variable does. But that's kind of a minor point. Right. So looking forward, and again, this is not some additional things that one could do. So you say yourself in the conclusion, you measure, of course, the average effects on GDP. But of course, we also know that there are distributional effects from crisis situation. Who gains, who loses, and I mean, again, this may be for a master student or PhD student of yours. There is data available. It goes back at least until the 60s, so you could actually also look into this. And then finally, this is not really a future research. It's more like a comment. So the early intervention, as you pointed out, were really driven by wars. As you said yourself, maybe we are going back to this period, hopefully not. But in general, it seems they are more exogenous shock rather than endogenous distress. I mean, COVID-19 is, of course, the best example for that. So maybe there is, in general, less concern about moral hazard. So anyway, I think I'm done. Yes, I don't have a concluding slide. I'm an austere person. So again, great paper. It was really a pleasure reading it, and I think this it addresses an important question. I really recommend everybody to read it. Thank you.
Thank you. So let's open the floor for questions, and after Maurice can reply to Torsten's comments. Yes, Governor Waller, please.
Oh, I can. Very nice paper, Moritz. I'm certain that your appendix probably has some of these answers. In evaluating this hypothesis, Did you think about things like recapitalization, a way to resolve the crisis? Is there a fiscal support? Because you're going back to a few hundred years, and the organizations, banking authorities were not as separated. Is the fiscal supports coming in? And for example, in the U.S., 1800s, all the time there will be banking crisis, and one of the ways that they resolved it by bringing banking holidays and other things and so on. So in some sense, in your paper, I'm sure you did some analysis to say that you are offering alternatives, and alternatives outweighs, and the liquidity is surviving every time, to make it stronger. Thank you.
Oh, sorry.
All right. Thanks, Morris, and also a very nice discussion, Thorsten. So when listening, each time I come up with different questions when you present the paper, Morris. So now I was struck by the following. So Augustine Carstens once told me that, so he was trained in the Chicago school, Milton Friedman, let's say, so very much into the moral hazard camp. And then you get catapulted into major crisis in your home country. And the first thing he did was to throw moral hazard arguments out of the window. And actually, I think they named him Saint Augustine afterwards. So I have two questions. One is, I think this biases against you finding anything. So kind of is another reason why the results may be biased. So it's really very striking that you still find what you find. But the other is related to also what Thorsten said. So like how stable do you think these ideologies are? And when you indeed, is it more of a country effect? Is it really a person effect? If you were catapulted in another country, maybe this is for another paper, but basically those few cases that you have where the ideology does not work as an instrument, they may be very interesting to study.
This one.
Okay, just a comment and a question. Very nice paper. For most of my career, I've always been struck by the fact that anytime you have anything that sounds like insurance, economists have this knee-jerk moral hazard. It's a quantitative question, and that's what I think is really nice about the paper. Like, insurance companies, they survive. When we put seatbelts and airbags in cars, we didn't see the number of deaths go up from car accidents. And this is just one of the most overrated, in my opinion, arguments I've ever seen. And it doesn't die when it comes to this stuff. So it does come down. And then the other thing is, when you have these financial crises, go ask the banks how well they were treated afterwards through regulatory actions. They didn't like it. So they paid for a lot of this. Wasn't like they got away for free and got to go right back to doing what they were doing. So that's just more in general. I like the idea. Let's start quantifying this instead of just automatically throwing out moral hazard. Let's let everything burn to the ground. And that's what it was really nice. The question I have is, you showed it in one slide, and I was wondering why you didn't use it throughout the rest of the paper, is the relative size of the financial sector to the economy, or this. This is critical. The bigger the financial sector is going to be, the more damage there's going to be from letting this stuff go. So those early years where it's less interventionist may just be the fact that you're seeing much smaller financial. So I don't tell you to go redo everything, but it would be interesting to have, and maybe you do, just sort of some control for that as you go forward in time.
Right. Over there? Sorry, please.
Thank you. This may be a naive question, but do you have any views on central bank contraction? Because the flip side of this suggests that, with your very dramatic charts, that there is some inclination to go towards lower levels of central bank assets. And I wonder what would motivate it, and whether there's some sort of desired steady state that you can point to.
Thank you. And last questions over Jacob, please.
Thank you. My first question relates really to the last one. We have a feeling that when we analyze the implications of QE, that the analysis is not complete until it is combined with the analysis of QT. And there is a feeling that the QT is still not complete, and in fact, that quantitative tightening is a different game. So I guess you don't finish the analysis until the other one is completed. And it means now that QT is not here just to offset the QE, but the less QE, the less QT is needed. So in other words, and I really want to ask you, how do you reflect on this? It's related to the previous question. Another topic that I want to raise, it has to do with when we speak about lender of last resort, and we put the danger that it may degenerate into becoming the lender of first resort, we are not only talking about the quantities that are being lent, but also about the quality of the assets. One of the issues in the crisis was that the banks found themselves accumulating bad assets in order to remove and relieve the quality of bad assets from the system. So the question is, how do you allow for the quality of assets that we are talking about, not just the quantity? And my last comment, and you alluded to it, is the single country or single episode versus group of countries. Because we do have, especially in the last crisis, the group of countries, so it was really the entire capital market rather than a specific balance sheet of a specific bank. Thank you.
Thank you. So let's go back to Moritz, please.
No, it's on. Okay, thank you. Yeah, thanks for these fantastic questions, Torsten. Thanks so much for the discussion. Doing justice to all these excellent questions would take a lot, but let me try to answer the essence of them. So, Torsten, starting with the discussion, this is country specific. So we have country fixed effects in the regression. So we look at the country specific variations. But that relates also to the question about the clusters. It's true that financial crises are clusters. I'll remind you that some of the global financial crises, the correlated crises like the Great Depression, have seen very different policy responses. So it's not always the case that everyone does the same in a crisis. And I think exploiting that variation is interesting and important. The other more banal answer is, as part of these robustness checks, we threw out 2008, and all of that works. That brings me to Governor Wallace's question. But otherwise, I mean, why not inflation? Well, because obviously inflation has something to do with the central bank balance sheet, and you get into all kinds of endogeneity concerns. So we stuck with this nominal growth. We used different thresholds, but I agree with you. There is no theoretical foundation why it would be 15%, not 20% or 25%. We just go through different thresholds, and the results are very similar. Brings me to Governor Wallace's question. I couldn't agree more. I'm a German, and the German debate is full of people who see moral hazard everywhere around the corner. And I always make exactly that argument. Just the fact that there's moral hazard doesn't mean that it's the dominant effect, and that this is where you should stop thinking, which my co-patriots often stop thinking when they think they've identified a moral hazard problem. So I couldn't agree more. I don't remember, honestly, if we included the size of the financial sector as a control in some of the regressions. I almost want to say we probably did, and sort of make a difference. If you're worried about crises occurring at low levels of financial depth, so to say, and these are the non-interventionist crises, and you think like the bigger the financial sector, the more important it becomes to stabilize. Then again, we're in this, I think we also would then say this probably, again, is a bias that would run against us, because these non-interventionist crises happen with lower financial depth. So maybe the effects should go in our direction, and it doesn't. But good question. Iftika, recapitalization, other policies. I think that's a very shrewd comment. We don't include them here. There is work that's being done on recapitalization. This is really a paper about sort of the liquidity support.
the question when you don't know. I mean, at least maybe, things have to go fast. You don't know, is this a solvency or liquidity issue? So this is more, we're in the Diamond Dybvig world here, not in a solvency, a fundamental solvency world. I'm working, and I know Luke and others have done fantastic work on this. There's obviously variation in these recapitalization policies. We control for the government response. So the expenditure or the government debt is on there, and that might be part also of the answer to your question, that the government takes over some of this in the gross public debt numbers. We see that, but in the work that I've done, we really get into a different territory of political economy. Governments like to save big banks. Governments don't save small banks. That's a paper I have with Matt Barron and Kasper Zimmermann. So there is, I think it's an important question, and I would like to keep it intellectual, separate from this question. And what we can do about this is basically control for the fiscal response that, again, it's imperfect, but that's what we do. Look, the change of governors, both in their beliefs and also people, you might say like, oh, there's a crisis and I helicopter in the dove as a government. First of all, we can exclude the cases where that actually happened, or where governor, also happens, like steps down or dies during the crisis, and then you get another one in. So we can take those cases out, and the results are fine. The change of belief, I think that happened. Mervyn King maybe is another example where recently there's a shift. There's two answers to that. A, I think the bias is not a problem for us. If anything, if a hawk becomes a dove, then okay. The other thing is that you would still see in the timing that maybe there's a little bit of a delay. And in some of these charts, you see that the hawkish response delays the intervention by some. I hope I have them. The QEQT, Jacob. So the Badgett dictum was, I think, lend freely against good collateral. In crisis, a lender of last resort, I think, has been the moral hazard camp has always said, well, you're no longer lending against good, you're lending against everything, and you're not even charging interest rates. Often you just, sort of give out this broad liquidity support. I think so there's no penalty rates anymore. I think the question, generally speaking, about sort of the net assessment of QE and then QT coming in is one that I agree with you. This is something that's very important for policymakers to think about. In the context of what we look at here, this is a sort of point intervention to, I would say, shortcut the bad run equilibria and the fire sale equilibria that might happen. It's not so much a question, or not so much a setting that allows us to study sort of the overall benefits of using the central bank balance sheet to, stabilize in the short run, but also like to bring up to lower the interest rate and kickstart investment. I think I want to think about this paper as a sort of narrower identification of the lender of last resort function, not so much of one of a permanent sort of quasi-monetary policy substitution for when interest rates are at zero or about. But yeah, how bad the crisis, well, last point I see you, Mark, is what we can do, and we did in the papers. So the question that I think Jacob meant is like, how did you go into the crisis? How severe was the credit bill? How severe was the misallocation? How different should the response be? What we can do there, and we do, is we can control for the pre-crisis of credit growth or leverage buildup. That's what we have in the macro control. So that's why I think like this is obviously not perfect in terms of the identification, but you can control obviously for the observables, and then you say like the question, is this a hawkish or a dovish governor, is sort of exogenous to the situation. That's part of the first. So the first stage is not free. There's controls in the first stage. That's the short answer to your question.
Very quick, Jacob, because we are at the coffee break.
The focus here was about the characteristics of the governor.
Yep.
In different countries, the decision maker is either the governor or the committee.
Yeah. No, okay. So there's strong assumptions going into this, and Torsten mentioned it. You're right. There's strong assumptions. The strong assumption is that Boris calls the shots.
No, I
That
understand the
there is the
assumption.
governor. The governor is the person that.
I understand the assumption.
Yeah.
If you do it on the monetary committee, which is the decision maker, it can be the governor who is the most dominant one for cases like this, but it will be the committee. So I wonder whether one cannot do exactly the same analysis, but instead of doing a governor, call it a monetary committee.
Yeah, I totally agree. I totally agree. This is if the governor is weak or the committee is strong, however you want to put this, then our first stages would be noisier, and so the governor ideology would not predict with great confidence the reaction in the crisis. I don't think it's in a narrow sense. This is a great question. We should do this in a narrow sense. It's not a problem for the identification, but it's something we should do. And I think Ulrike Mamandier and Corsa, they have papers where they look at the overall composition of the monetary policy committees and do sort of a weighted hawk-dove balance. And we could totally do this. And Torsten just offered he's just going to do collect the data.
You could do it. I didn't say that.
Okay, so thank you, Moritz. So let's now move on to the question of sovereign debt and fiscal integration in the EU. And Zlot, please, over to you.
Thank you very much. And first of all, let me also thank Boris, Paul, and the Croatian Central Bank for having me here. And I look forward to having an insightful discussion. So I go back to the bread and butter of central banking, one of the elements which is fiscal policy and public debt, focusing on the European Union, but we also have included the United States and the UK for comparison. And this is based on a couple of joint works with Lennart Verslau and Jeromin Zettelmeier. So let me start to outline what I will talk about. So, we can all recall the Eurozone crisis of the early 2010s, when there was a major risk that a self-fulfilling crisis might even lead to a breakup of the euro area. And various institutional reforms have been introduced. Also, the European Central Bank became much more willing to tackle also sovereign debt issues by developing a couple of instruments. So as of now, we ask the question that how far we got, whether the problems which were there in the early 2010s still prevail, and what could be done. So I will focus on 4 issues. The first one is the well-known doom loop between banks and sovereigns. Again, this was a major reason for the severity of the 2010 crisis. Lots of banks in Italy, Spain, and elsewhere hold the debt of their government. And as their government faced pressures, the banks, via their balance sheet, also faced major pressures. Then came President Draghi with his favorite whatever it takes speech and introduction of the outright monetary transactions, which was probably designed in a way not to be used ever. But we also, in 2022, we saw a similar situation when, due to the rising, skyrocketing inflation, the central bank started to raise interest rates. Obviously, all government borrowing costs started to increase. But also the spreads compared to Germany started to increase quite substantially in a number of countries. And at that time, there was a lot of talk about so-called financial fragmentation in the Eurozone, both in policy discussion. If you open the financial press, you saw it every day. But even the ECB Governing Council was so scared that they called for an extraordinary meeting between 2 scheduled meetings, and announced the development of a so-called anti-fragmentation instrument. Now we know 4 years later that basically nothing happened, but still that episode in 2022 was I think, very meaningful, and basically we use this to test whether this adverse feedback between banks and sovereigns has receded due to the various reforms. Then we turn to solvency issues, looking at public debt sustainability using 2 methods. The first uses stochastic debt sustainability analysis, and the second one, various fiscal reaction functions. Then I go to fiscal rules. The European Union introduced new fiscal rules 2 years ago. We look at how adequate these are for the current circumstances and also for fostering sustainable fiscal policies, but also economic growth. And finally, I go to the EU safe asset issue, whether it is needed, and if so, how. So let me start with the doom loop issue. So this chart on the left side shows many lines. It shows the bank exposure to their domestic sovereign as a share of equity capital. You're probably not able to identify all countries. That's not an issue at all. But the big picture that you can see here is that, there are still, as of now, there are very high values. A couple of countries have over 100% exposure, but also many others have over 50% exposure to their domestic sovereign. And clearly, this creates the potential that a sovereign stress might be transmitted quickly to a banking stress. And again, you all know, there are many central bankers here, that the European Central Bank introduces various tools to address the situation. I already mentioned the outright monetary transactions, the transmission protection instrument, also the ESM was created. And also at the same time, there were lots of done on the banking side. My colleagues here might know much better than me, but banks have to hold much more capital, liquidity, and so on. So what we did is a little event study. Similarly, that was done by Altavilla and his co-authors for the case of the OMT. So what we did is compare the transmission protection instrument and the OMT announcement dates, and looked at how the spreads of banks and the spreads of sovereign responded, both then and now. And the key message is that when the OMT was announced, there is a strong negative impact on spreads of both banks and sovereigns. And again, this is what we had expected, but it also reflects that the two main entities are highly interlinked. So as the risk in one went down, also the risk in other went down. But with TPI, we observed an asymmetric impact, namely it had an impact only on sovereigns. So sovereign spreads declined. Bank spread didn't really fall. So this might indicate that the two, the banks and the sovereign sector are somewhat became not as much interlinked or interdependent than before. So this is certainly a good sign for the doom loop. Now, in terms of sustainability, so we use two methodologies. Both are fairly standard, so we made some little changes, improvements here and there, but basically what we do is relatively standard. So we first look at or estimate what level of structurally primary balance is needed or would be needed to stabilize the public debt to GDP ratios after 7 years. We have chosen 7 years because this is the longest time horizon allowed by European fiscal rules to make a fiscal adjustment. And we assess the feasibility, whether this could be done by looking at both the level, so what level of primary balance countries will have to reach, but also the change, what adjustment is needed to get there. And we use a couple of benchmarks. We use a historical precedents over the past half century, both from all advanced countries and from the country in question. We look at fiscal plans of countries and also IMF projections. So this is the one analysis. And the second one, we estimate fiscal reaction functions. And we check whether this is still strong enough, namely that whether an increase in the debt ratio will generate an increase in the primary surplus. So on the first methodology, so estimating a structured primary balances that stabilizes that, some differences with the Commission methodology is that we allow asymmetric distribution instead of the Commission assumption of normality. The Commission assumes that during the adjustment period, which could last for 7 years, there is no uncertainty at all, which we think is not well justified. So we allow uncertainty during that period. And also quite a difference is that we use a 20-year forward-looking far chart instead of the Commission looking forward only 5 years. We also adopt a somewhat different definition of what debt stabilization means. So in principle, we would want debt to stabilize over the long horizon, but obviously data availability and also the uncertainty in estimates requires us to set a certain period. So we look 20 years ahead and basically require that in the last 5 years of the 20-year period, the public debt to GDP ratio should be stable with a probability of 70%. This would mean that the mean and the median would go down. So in the mean and the median public debt is expected to fall over the end of this 20-year period. But again, we will assume that there should be at least a 70% probability that that will not explode at the end of the 20 years. Now, here is a table with two main conclusions. The table might be a little bit large and lots of data, but I hope I can easily explain the key messages. So, so importantly, in column 4, you can see the level of the structural primary balance that has to be reached. And what you can see here is that in general, these are not overly high. I mean, there are only 2 countries, Greece and Hungary, which has more than 3% primary balance target for that stabilization. For all other countries are below that. For example, you can look at France, 1.2% of primary surplus. It, in itself doesn't sound very excessively high. Croatia is not included here because here we looked at countries which have either more than 60% of GDP debt or more than 3% of GDP budget deficit, and Croatia is slightly below both of them. But in another paper, we also made estimates for Croatia, and we found that that stabilizing primary balance is around 0.5% of GDP, and the adjustment requirement is about 2%. So I'm not that worried about Croatia, I have to say. But there are some countries about which I'm worried. And those are in column 4, column 5, indicated with this yellow type background. And look at, for example, the United States and France. So the adjustment requirement the US has to do is close to 6% of GDP, while the adjustment that France has to do is about 5% of GDP. Again, this has to be done over 7 years, which takes some time. But still, this is quite sizable. So what we did is that we looked at basically 3 benchmarks, whether these adjustments look feasible or plausible. Now, first of all, for EU countries, we looked at the fiscal plans, the so-called medium-term fiscal structural plans that countries prepared, and they generally found that they tend to, at least they have the intention to comply. Now, for the US, there are no such plans, but there is luckily still an independent Congressional Budget Office. And if you look at those projections, they basically project unchanged primary balance over the next decade. So the US clearly runs the risk of substantial further increase in the federal debt to GDP ratio. Second, we looked at the historical precedent, which the word clearly summarizes is very discouraging. So we looked at a large set of advanced countries over the past half century. And again, I said that for France, the adjustment requirement is, let's say, 0.5% of GDP. Now, when we look at all countries, all advanced countries over the past 50 years, around 11% of the sample, countries were able to do such adjustment, or not able to, they did such adjustment over 7 years. But it never happened in France. So France never did such an adjustment that it would need to do. we also, I mean, Romania has even higher budget deficit than France, and we also find the same. And we also took IMF as a benchmark. So I mean, the IMF publishes a point forecast, but with the bootstrapping technique, we created some probability distribution. And again, we generally find discouraging results. That it's IMF thinks it's quite unlikely that countries will make this adjustment. So the bottom line is that I mean, this can be okay. I mean, countries not doing adjustment, but only until market pressure doesn't increase even further. Now, time is running. I have only 2 minutes left or 3 minutes left. So we also estimated fiscal reaction functions, which is a very simple form. Basically, we regress the primary balance on the lagged value of debt, a lot of controls, including fixed effects for countries and years, and a lot of controls. And we looked at this parameter rho, which shows how the primary balance reacts to the debt level. And what you can see here on the chart on the right panel, we did 15-year rolling sample estimations. So you can see the sample on the bottom of the chart, and looked at basically how these rho parameters evolved either in the group of countries, which are in the top left panel, or in the individual countries. And again, the key message is that it tends to be positive. In the past, it was also significantly positive, which is good news. But practically everywhere, there was a gradual decline in the response of the primary balance to rising debt. Again, so this is a very, very some result. I don't have time to elaborate more. Now, quickly on fiscal rules. So perhaps many of you know the single operation indicator of fiscal rules is the so-called net expenditure growth of the general government, which exclude interest expenditures and a couple of things. And the European Commission provided so-called prior guidance to each EU country, or not each, but most EU countries. And on the chart on the right side, we showed what is the difference between this net expenditure growth in the country plans compared to the Commission. So when it is positive, countries plan to spend more than what the Commission calculated initially that would be consistent with that sustainability. You see two particularly large differences, one for Finland and the other one for Germany. Now for Finland, it's mostly technical, and it's not an issue. It's mostly results that Finnish are super prudent because they save the public pension saving surplus. They don't use it for general financing of the budget deficit, but accumulate in a separate fund. And due to some details, some safeguards in the fiscal rules, it required Finland to achieve the highest structural primary surplus. So Finnish deviation is not an issue, but the German deviation is an issue. And let me come to that because my time is, I'm afraid, already over. So for years, we called Germany to invest more. And in 2025, they did it. So wonderful, we were so happy. They even changed the constitution to make this happen. So in the constitutional debt break rule, they excluded security spending over 1% of GDP from the rule, and also allowed extra budgetary investment fund to be outside the rule. So we were, from an economic perspective, we were really pleased and really welcomed this change. But the issue is that Germany is a member of the EU. European fiscal rules applies to Germany, which was to some reason made tighter because of former German demands. And now EU rules are much more tighter than the German national rules. So how Germany reconciled its plan to spend more, invest more in defense by basically two tricks. First is making very optimistic growth assumptions, and this is illustrated on the chart. So the line, the red line, shows German potential growth as it is included in the German plan. And the other line shows, a couple of estimates, either that time or more recent one, like the latest European Commission forecast. And you can clearly see that this increase in potential growth from 0.5% to 0.9 immediately in 2025 is clearly unrealistic. So that's one thing that Germany did, and obviously it will not happen. And the other one is that they promised a strong fiscal adjustment. Not now, but 3 years from now. Both are very unfortunate. So unfortunately, my time is over. So I don't have to talk about safe assets, but we endorse some of the proposals, including the recent one by Olivier Blanchard and Angel Ubida. So I have a concluding slide, but I might not have. Do I have the time to go through it, or? Just 1 minute. Okay, so just 1 minute for the overall conclusions. So one good result. The first point is a good result. The other are more challenging. So again, even though the large dependence on domestic banks on domestic sovereign remains, at least we found that the doom loop has receded significantly. Again, that sustainability. The good news is that the level of primary balances needs to be reached is not excessive. But the bad news, point 3, is that the adjustment requirements are very large. For some countries like France, this never happened in their history. So they may take more time, but point number 4, they will be much dependent on market confidence. We have already seen when Emmanuel Macron called for snap elections, and that led to this hung parliament, that the spread of the French 10-year bond to the German bond increased from about 40 basis points to 80 basis points. So markets are there. This is good news. But again, if going forward, if the French budget would not be put on a sustainable path, then market might shift. Number 5, fiscal rules. So again, the general framework seems good, but a major issue is that it severely limits the investment opportunities of those countries like Germany, which has a debt ratio over 60% of GDP, but very, very low unsustainability risk. And finally, again, we endorse increasing the safe asset pool of the EU, but it would be best if it would be a dedicated EU revenue stream would support that. So let me thank you, and I look forward to your comments.
Thank you. So let's now move on to our discussions. Eva, please.
Okay, so thank you, Boris, and to the Croatian National Bank for inviting me to this fantastic conference. What a setting. Great papers, great discussions. So the usual disclaimer applies. This cannot be attributed to the IMF or to members of its executive board. So let me just step back and quickly summarize what this paper does. The paper does a lot of things. I'm going to just focus on a few key elements of what the paper does. It asks whether, despite recent reforms, the euro area is actually prepared for another sovereign risk crisis. And the central point here is that there is no centralized fiscal authority. You have a lot of heterogeneity across countries, and as the chart shows, you have a wide dispersion with many countries positioned above both the 3% deficit and the 60% debt thresholds. And this heterogeneity is central because it raises the question whether a single framework can manage very different fiscal positions. And from a solvency perspective, the paper does two things. The first thing is it uses stochastic debt simulations under uncertainty. And the second is that it estimates fiscal reaction functions, and basically how do primary deficits respond when primary balances respond when debt rises. And what they find is that under current policies, debt stabilizes in most countries. However, in some countries with much weaker fiscal positions, much larger adjustment will be required than what is seen by history, given current plans, and also future projections. And also, importantly, which Zolt didn't have the time to emphasize, the fiscal reaction function has weakened. right? So how countries respond to debt increases has weakened. And this is true not just for the EU, but this is true for the US, even more so. And so perhaps the conclusion takeaway is that the system overall is more resilient than before, but it's not fully crisis proof. And I wanted to step back a little and sort of ask this question, well, why is this challenge even more pressing today than it was, say, a few years ago? Once we factor in structural pressures already in the pipeline, you see what happens between now and 2040. And this is a new analysis by my colleagues in the European department at the IMF. And what they show is that public spending could rise by about 4% of GDP in advanced EU countries and about 5% in emerging EU by 2040. Now, these increases are being driven by aging, higher defense spending, climate transition costs. And the important point is that these are persistent. These are not just temporary one-off shocks, these are persistent shocks. And without adjustment, mechanically, this is going to push up deficits and debt. And so if policies remain unchanged, the debt outlook deteriorates significantly. And again, sort of the analysis shows here that the average sort of debt levels could rise from about 65% to around 130% of GDP by 2040. And the key issue is the trajectory. Okay? As debt crosses this dashed line, which is some sort of an estimate of a safe debt, mind you, estimates of safe debt can vary dramatically. This is for the average country in the EU. These are not time variant. They depend upon the nature of shocks. But that said, what you see is that as debt is increasing, it's going to surpass some notional safe debt threshold, and that increases default risks. So that's the starting point. And what the paper does, it says, well, overall, we see that the system is broadly resilient. We see areas for tweaking, some proposals, and there are three main reforms that the paper proposes. The first is that they argue that we should have higher and risk-based debt limits. So in other words, recognize different capabilities or capacities to repay debt across countries. And fundamentally, this means raising the EU threshold, the 60% reference threshold to say 90%, and allow country-specific debt targets based on underlying vulnerabilities, debt carrying capacity, and so forth. So that's the first proposal. The second is to exempt EU-vetted public investments for climate, for defense, and such from fiscal rules. And this is still conditional on debt remaining on a downward path over some time horizon. And the third proposal is to expand EU assets beyond next-gen EU and to create a larger pool of euro-denominated safe assets. This will allow for better risk sharing. This will allow for common provision of public goods. So these are the paper's proposals, broadly sensible. I'm not going to discuss the methodology because the paper was already published last year in the Journal of Economic Perspective. So I'm not really going to talk about whether the estimates for the fiscal reaction function could be tweaked and how they could be improved. But I'm instead going to focus a little bit on the economics of debt dynamics, incentives, and implementation in areas where they're particularly critical. So my first point has to do with this notion of fiscal rules are relatively new. In the new fiscal rules were put in place last year. And the question of flexibility versus compliance is a fundamental one. If rules become more flexible, say allowing for higher debt limits or investment carve-outs, they must be more credible. And as seen in this figure, history does give us pause. For many countries, you see this persistent break or non-compliance with fiscal rules in the region. So in other words, you can have flexibility, but what is there to incentivize compliance? And that's not entirely clear. The paper talks about sort of the avoiding the trap of rosy assumptions and the importance of realistic forecasts, and risk analysis and medium-term plans. But the evidence shows that fiscal reaction functions have weakened. And what that fundamentally means is that many EU countries aren't adjusting strongly enough to debt now. And this weakened discipline means that we can't just rely on countries to self-correct. Right? And the political economy has changed fundamentally in many countries. So the question remains, how can you have rules that are credible? What mechanisms exist for commitment, and how can they be enforced? And the paper is relatively silent on these, but very important questions. My second point has to do with their proposal on carving out investment from existing rules. Growth is important. There's a public good component, as I've said before, to defense, to resolving the climate transition. But at the same time, it cannot be without safeguards. And analysis by my colleagues at the Fiscal Affairs Department shows that public investment is not a free lunch. Okay? And this can be seen on the right-hand side, where they used model-based analysis to estimate fiscal multipliers and to show how they depend on financing costs that countries face. For high debt countries, debt finance investment can actually add to risks unless it's offset by savings elsewhere, as multipliers are much lower, as seen in the red line. So in other words, the growth dividend that you receive from this investment is much, much lower than you would otherwise. A similar story emerges if you look at countries that have much less fiscal space. So in other words, you can't bank on investment. You can't bank on investment bringing the growth dividend that you need and then allowing debt to go down. And that's an important point. So any carve out of this kind of a golden rule, we've been there, we've seen this before in other contexts. It must be conditional, tightly limited, temporary, and perhaps reserved for lower debt and solid performers and subject to independent review. And this also prevents what we've seen in the past, what we call creative accounting, where ordinary spending is relabeled as investment and to bypass the rules, and essentially basically making, rendering this kind of investment not very growth friendly, because it's really not investment. So how do you do this in a way that prevents misallocation of resources, prevents creative accounting, is an important question. And without these kind of guardrails, these kind of reforms could really backfire for more vulnerable countries. So it's important to think about what are the guardrails here. My final point has to do with this broader question of how do you balance deeper integration with national discipline? Integration clearly offers benefits, including more safe assets and less financial fragmentation. It can, as I said, it can lower the cost of common priorities and so forth. So particularly in areas where there's a clear public goods element. But integration does not solve the solvency problem fundamentally. It does not solve that. And that still relies on, in other words, debt sustainability still relies on national fiscal policies. And this creates a risk, again, free riding. We talked about moral hazard in the last presentation. It creates a risk and it raises important questions about burden sharing. Who will pay? So as a result, integration must be matched with credible national discipline and linked to robust fiscal rules. The challenge here is that the new rules were put in place last year, but escape clauses were already evoked because of higher defense spending. Now, higher defense spending is going to be permanent. It's not a temporary phenomena. The question is, the credibility of the existing rules has not been tested. And if we sort of push the can down the road and say adjustment comes over some horizon, then how do all the little pieces fit together, right? So this question of, how do you balance flexibility with credibility it remains. And supporting investment and integration is really necessary, but it must be somehow anchored in realistic plans, stronger oversight, and if done well, it can work. The question is, are all the various pieces going to be able to fit together into a cohesive whole? So let me stop here. Thank you.
Thank you, Ira. So let's now, before the coffee break, please take some questions and answers. So yes, over there. Governor after, so Shaheen.
Okay. Good morning. Thanks for the presentation. Quick question for Scholt. Maybe I wasn't fully awake yet at the beginning, the story about the doom loop and the ECB programs. Maybe I understood wrong, but you seem to be making the point that OMT and TPI had a different impact on the spreads of sovereigns versus and banks differentiate. So why? I guess the question is, what was your starting point? In a sense that doesn't really come. I'm not sure it comes as a big surprise in a sense that they're very different programs, very different conditionality that comes with it, very different parts of the market that those programs attack, and sort of they're conceptually very, very different. So I'm not. Maybe you can just go back to what your expectations were on that, please. Thank you.
Thank you, Governor.
Thank you. This is an excellent paper, and also the comment coming from the IMF. I think there's no doubt that there's an improvement over the previous years in the fiscal governance of the European Union. So my question is, first of all, the improvement of the architecture, as you mentioned, is it a positive triggered effect for the future? I mean, if we proceed with banking union, with savings and investment union, will this improve? Will this reduce fragmentation? So makes it much more efficient, the public debt governance. Second question. Is it enough to talk about only public debt and not public and private debt? We have ignored this for many, many years, but for many countries now, it is not only public debt that matters, but also private debt. Could this be incorporated into the analysis? And finally, it's very worrying, the IMF diagram that with no policy action, the public debt to GDP ratio in the European Union is going steeply up. I mean, we have not taken this into account recently, so perhaps you need to elaborate, because perhaps we are more optimistic about that in Europe. Thank you.
Thank you. So I take Shaheen, please.
Thank you. Two quick questions. One to Jolt. You've been passing very quickly on your safe asset section, so a question on that. I was surprised that you said you supported the proposal by Blanchard and Oubidé. I was more under the impression that you supported common debt for the purpose of financing common public good rather than mutualizing past national sovereign debt. So I'd love to hear you on that. And to both of you, Jolt and Era, you've stressed the friction between the European fiscal rules and the national debt brake in Germany. How do you think Germany should square that? Should Germany scrap its national debt brake and basically just follow the European fiscal rules? And should we reform the European fiscal rules further by including more safeguards for public investment and more safeguards for defense spending? We seem to have tried to do that ex post through escape clauses, but maybe there's a more systematic and rigorous way of doing it. So are you quietly advocating for yet another reform of the European fiscal framework?
Thank you. So there was someone, no? Yes, please, in the front.
Yeah.
Sorry, I give you.
It's my turn. Okay. Helge, IMF. So, Jolt, you were very polite on the EU fiscal rules, and as a private question to you, not a fund-based question, are they really working if the high debt countries are constrained by interest rates, right? You mentioned France, you can add Italy. If it is correct, as Era showed, that we're looking at significant additional expenditure obligations going forward, which are not accounted for, right, by the European fiscal rules right now, sort of, are they working or are they actually too generous? And we need to see how they play out, but they may require a second look. And then secondly, isn't a major implication of the constraints that you visualize and calculate for many of these high debt countries that we need to think about the other gaping hole in the European fiscal framework, which is the lack of a central government. There is no centralized risk sharing across the European Union. The government, so the budget is too small for that. We don't have a dedicated instrument. We don't have public goods that are significantly large and jointly financed, which would also implicitly allow some fiscal risk sharing. So if you constrain all these countries at the national level, isn't that something that we need to talk about alongside with the banking union and other missing elements?
Thank you. In the front and after Jan, please.
Yes, thank you for your insightful presentation. I'm wondering whether you have make some sort of sensitivity analysis adjusting structural primary balance to NGO grants, because at the working group for public finance at ECB, usually get different expected fiscal efforts when adjusting SPB for NGO grants. So I think it's a big technical difficulty in DSA toolkit. And also regarding your comment on Croatia and looking at recent data regarding the deviation from the medium-term structural fiscal plans. So looking at cumulative growth rate, we are currently now around 36%, which in terms of deviation is around 6 percentage points. So only Malta is worse than us. So you can see that picture can change within 2 years, although fiscal rules were implemented and national rules were not implemented. So it's also one big difference between countries who implemented national rules aligned with EU rules and those who did not implement any national fiscal rules.
Thank you. Final questions, Jan, please.
Right. I want to follow on national fiscal rules because an easy thing to detect in what's going on in fiscal frameworks is that some countries have very powerful national fiscal rules, others less so. One of the examples I would give here is Poland, which in one of Zolt's slides you identified as being most at risk, yet they have a very hard 60% debt limit in the constitution. Therefore, they're not going to go over it because it becomes so difficult. So I think in analyzing this, we should not get stuck on the 2024 governance reforms, but also pose the question of whether what's gone before has created things that override the EU rules. It's true in Sweden, it's true in Poland, it's probably true in Slovakia, to give 3 examples. And a very short point to Era on golden rules. Yes, we all know about the slippage from defining everything as investment. I wonder whether a better conception for a golden rule would be simply, is it growth promoting, not whether it's investment or not investment. And you therefore have something that is more credible in avoiding this, provided you can define what creates growth. And this is something the European Commission has pushed over 20 years, which is the idea of quality of public finances.
Okay, thank you. So, Zlot, over to you.
Thank you so much. Excellent, insightful, and very extensive comments and questions. So, how much time can I take? Okay.
Good.
Okay. So let me start. Just one clarification. Also, one question related to Helga is that the spending needs ahead of us. So the DSA that incorporates spending needs related to aging and the implications of aging, partly because it based on long horizon projections, which labor, working age population is set to shrink, and this is incorporated in potential growth, but also on the cost side, the increased costs of pensions, old age care, healthcare, and so on. So these are included. What is not included is extra defense spending. So that's a major element missing, but at least part of the increased spending challenges are included. Now, let me go in the order and basically briefly reflect first the 3 main comments of ERA. So the first one was that what about fiscal rules, making them more credible, and you emphasize that there is a need for a clear correction mechanism when plans go off track. Now, However, I think that fiscal rules are useful, important. I don't believe, and this is, I think, could be shared, that they can't solve every problem. So also in the past, we have seen that European fiscal rules were very often, interpreted flexibly, even neglected. I mean, you can look at the French budget deficit over the past 20 years. I mean, there were very few years, if at all, when it was below 3%. But at least, first of all, they provide an indication. So French deficit didn't become, 10 or 15% of GDP, but, just somewhat larger than 3. And again, fiscal rules, especially the European level, is a very politicized process because the Council of Finance Ministers decide on whether to sanction a country or not. And they don't want to sanction others, fearing that next time they will be sanctioned by those who they have just sanctioned. So again, fiscal rules cannot solve all problems, but luckily we have the market, and market is there. I mean, look at, for example, Italy. When Giorgia Meloni came to power, there were lots of fears that, since she was regarded as a populist politician, that she might screw up the budget, but it didn't happen. She followed a very conservative policy because she learned from her predecessors that in around 2012, Italian yields skyrocketed, and she realized that if he follows an irresponsible fiscal policy, then she might, get out of power very quickly, as maybe Liz Truss has experienced a few years later. Also in France, again, the spread to Germany is higher. Now the market is probably waiting what will happen also at the next election. But again, the market is there. So, and I much more believe in the disciplining force of markets than designing a super clever fiscal rule which would somehow able to keep these countries off track. Now the second, investment-friendly fiscal rules, and that this doesn't pay off by itself. I 100% agree. So we have another paper in which we made simulations on how much larger structural primary balance should be achieved if countries implement an investment program like Germany for 11 years. And yes, obviously that increases at that level, but the marginal increase in the long term or the target primary balance is not that high, because after there will be, the country will have a long period to work that down. So so yes, it has an impact on the overall adjustment need, but not dramatic, even if they add 10% of GDP or even more to the public debt ratio. And again, not to mention that which is also related to your third question on the balancing integration and investment, that so what we call for is a very much risk-based flexibility for investment for countries where fiscal risks are relatively low. I mean, again, the prime case is Germany now. So we don't suggest that Italy should suddenly, engineer a major investment program. We have to realize that the country doesn't have fiscal space. So, but for Germany, we would allow for Netherlands, and would allow for a couple of other countries. Also, your point that the third point, that common debt would not resolve solvency. Again, we fully agree, but nevertheless, it could still help on the margin, creating, as you said, also liquidity, more efficiency. Olivier Blanchard also argues that it would also lead to a slight reduction even in the average interest rate, because if there's a greater pool, I mean, they propose a 25% of GDP swapping of national debt to EU debt. So it's a much more bigger market, more liquid, that could, especially if it would include it in sovereign bond indices, that would boost the investor base and could lead to lower rate. Obviously, the national compartment interest rate on the national debt would remain higher, but on average, it might go down a little bit. But again, we don't suggest it for solving solvency issues, not at all. I very much agree with you. We suggest it for again, efficiency, also capital market development, and for the international role of the euro. Now, Andreas, on the OMT and TPI, yes, you are fully right that the circumstances were very much different. But one thing was similar, namely that the rise in sovereign spread was unexpected. So neither in 2011-12, anyone, including myself, expected that there would be such a big increase in spreads. Nor initially in let's say 2000 early or in late 2021 or early 2022, nobody predicted that the spread relative to Germany would increase. And given that banks continue to hold a very large share of the national governments, they might, obviously this indicates a fragility. So if sovereign comes under stress, then also banks can come under stress. Now, what we did is this, analysis. We looked at the two announcement dates for the TPI. First one, as I mentioned, there was an extraordinary governing council meeting when they called for such an instrument, and a few weeks later they actually announced it. For the OMT, there were 3 such adjustments. So we looked at what happened around those dates. And the key finding is that at the TPI, it only had an impact on the sovereign, but not on the banks. So it means that for us, that a reduction in the sovereign stress didn't lead to a reduction in bank stress. So probably the bank stress was not really driven by the sovereign stress. So this, to some extent, you might not agree, but this to some extent for us indicates that they are less linked than before. Governor, three questions. So improvement in the architecture, how would Savings Investment Union further help? So I think if a Savings Investment Union, I think would help a lot for development of European capital market, for promoting disruptive innovation, including more venture capital financing. I don't think that itself that would mean much for sovereigns. For sovereigns, what would mean, apart from the fact that it boosts growth, then obviously the indirect benefit from growth, benefits obviously the public finances. It mostly be for the private economy and economic development. Now, on the second, private debt, we didn't include it. Indeed, that's a fair point. I mean, we focused on public debt. Now, from this perspective, the key question is whether possible private debt stress can transmit into governments. And obviously it can, because if it stresses banks' balance sheets, then obviously that's bad for the whole economy, and that's also bad for the budget revenues and the government and so on. So it's a fair point. We didn't include it. And the third point on the IMF projection that the debt to GDP ratio increases. I think your projection, you might be better answer that based on the most likely policies that you expect now. But again, as I argued, I mean, if things get out of control, then markets will come in and discipline countries. Also, if you look at Germany, again, partly due to these overly optimistic assumptions I mentioned, the public debt will increase much faster than they planned. So not just due to the defense component, but I'm looking at the time, but also to this very unreasonable plan. But I think there is a culture in Germany which sooner or later will say, no, we have to stop this. We can't increase the debt over 100% of GDP, so we have to do a big fiscal adjustment. And then that will be bad for the economy, but at least the debt to GDP ratio will likely go down. Now, very quickly, Shaheen, yes, I also endorse European public goods financing that by common borrowing. For example, you might know that Guntram and his co-authors called for a European defense spending mechanism, and they found that about 2 trillion, there would be a project for about 2 trillion euros common defense spending. It would be ideal to finance that from common borrowing. I very much agree. I ran through the slide. I had two bullet points that this is one option to increase the common pool of EU assets. The second one is basically somewhat swapping current debt, and I only emphasized that in my presentation. On your question, what Germany should do, whether it should follow the European fiscal rules, clearly not. Again, it is very desirable that Germany spends more on infrastructure. In brackets, how well they spend is a question. I mean, the Bundesbank had a couple of analyses showing that they, in fact, use it to spend more on social because they switch some of the regular investment to the investment fund and use the leeway for social spending. So quality of spending matters, but at least we want Germany to invest more. So I don't want them to follow the European rules from an economic perspective. From a legal perspective, obviously, they have to. But I think the rules should be changed so that Germany wouldn't need to recourse on such tricks that assuming overly optimistic assumptions and promising a very backloaded fiscal adjustment, which I think is very incredible. Do I have more time because there's still more? Okay, we can discuss in the break.
Thank you. I'll be brief. So on the EU fiscal new fiscal governance framework, I think the proof is in the pudding. I mean, it hasn't been tested yet, and so I agree that even if these are notional, I think the credibility of fiscal policy matters. So you could say, well, this is a political, sort of calibrated numbers. They don't, the sort of the medium-term path is politically determined. But the point remains that fiscal policy requires credibility. Even if you're thinking about market reaction or to stave off market reaction, you need that kind of notional credibility. And from that perspective, I think it's too early to say that the rules should be changed. I mean, they haven't even been fully applied yet. And I think really that the challenge, not just in Europe, but for many countries around the world that we're finding, is that implementation is really lagging. You can announce anything. I mean, the UK is an interesting example where you've had fiscal rules change 19 times over the last, so 20 years or something, or 25. Well, it's we counted it. I mean, there's sort of mini rules that they've been changed. The point being that implementation is really key, and again, implementation and not in all states of nature. Of course, there's a major shock. You invoke escape clauses. You create that flexibility when you think about a medium-term orientation. But the point remains that you need to sort of see whether broadly you're complying with, in a world, I should add, where there are more recurrent shocks, something that we talked about yesterday. There are more recurrent shocks. Countries have less room for maneuver. At the same time, the imperatives to spend more, whether it's defense or energy transitions or aging, are rising. So I think squaring that circle remains, and the rules have to sort of be implemented in some form. And we'll see. We'll wait and see what happens over time. So I think that's one point. On the investment and the golden rules, I mean, I think fundamentally it depends upon the multipliers, and we've done quite a bit of analysis. My colleagues and I, in sort of estimating these kind of multipliers. What are the productivity benefits of sort of these growth promoting spending? And it varies tremendously. I mean, there's an efficiency component, other aspects. So while I agree with you, I think it's really hard ex ante to say what will be growth promoting. So let me stop there.
Okay, well, thank you very much to all our panelists, our speakers, discussions, great paper, great presentation. So we look forward to a great coffee break, and let's extend a warm applause for our panelists. Thank you.
But I enjoyed reading your paper. It was very, very interesting.
Yeah, very nice comment. So
thanks.
That was very good. Thank you. Thank you. Thank you. Yeah, thank you. Great work. Thank you. No, it was excellent. No, it's fine. Very good.
Hello, everybody. Welcome back for the next exciting topic of the Dubrovnik Economic Conference. We are going to hear from Catherine Schenk from Oxford University on moving money, public and private. Can you go back? There you go. Public and private interest in the architecture of global payments. This is the second in a series around payment systems at the conference, starting with Helene's intervention yesterday and going through on sort of stablecoin and digital payments later this afternoon. Catherine is going to take us through this topical question through a really excellent set of slides looking at sort of some of the history of where we've ended up today, and hopefully opening up a bunch of questions that we can dig into both through Roland's discussion and then through Q&A with the audience. So thank you very much, Catherine, and over to you.
Well, thank you very much for the invitation. It's been an absolute pleasure, and thank you all for coming in out of the sunshine for the last session before lunch. So I think we're all aware of the challenges in the global payment system. I think of this system as the fundamental plumbing of globalization. Those who are involved in it don't always like to be called plumbers. Sometimes they like to be called architects. So another metaphor is the architecture of the system. But the thing about plumbing, and the reason why it's such a good metaphor for cross-border payments, is that you don't worry too much about plumbing. It's out of sight, out of mind until something goes wrong. And then it's an absolute disaster, which has a lot of, oh, here's a pun again, spillover effects, if you like, when it goes wrong. There's a kind of a key set of things that you want from a cross-border payment system, like you want from your plumbing. You want it to go seamlessly. You want it to go invisibly. You want not too many frictions in it. In terms of payments, being cheap, being fast, being secure, being stable, maybe being transparent, maybe not. And we'll talk a little bit about the AML CFT type of compliance issues. It's something that has network externalities that Helene was talking about a little bit yesterday. And these network externalities encourage a convergence of standards in order to capture them. There's the influence of technology. And perhaps even convergence on currency, or as we heard in the international currencies talk by Helene yesterday. But there's also gatekeeper rents. So acting against these network externalities is their interest in creating rents out of the being a gatekeeper into the global payment system. And this can create bottlenecks and unequal access to this quite fundamental utility almost. Most recently, we've seen a contraction in bilateral correspondent banking, which has attracted a lot of central bankers and the BIS. And also, we've had identified as part of that a lot of the points of fragility that this system has. And these are highlighted now, particularly in a time of geopolitical fragmentation, and are attracting the attention of what the impact of our current moment might have on this underlying structure. So the sanctions, the AML compliance, geopolitical fragmentation are all really current pressures on the system. At the same time, we have a lot of innovation and proliferation going on, so technological innovation, but also fragmentation as part of the geopolitical issues going on. And since 2020, this has been a priority of the G20, the FSB, and the BIS. So just to give you a kind of an image from a paper published on behalf of the CPMI, this is in 2020, and this is the length of time that it takes to settle finally. So you can see the unequal geographic distribution of the SWIFT settlement system, ranging from almost 24 hours down to minutes. So it's this kind of inequality that has attracted the attention of policymakers and governors. And this is the kind of the wheel of the G20 cross-border payments initiative, identifying a lot of frictions, developing a roadmap and a roadmap towards the roadmap, and then building blocks towards the roadmap and this sort of thing. So it's generated a lot of heat and discussion and really attracted attention to something that I was interested in as a historian that suddenly had much more current relevance. Okay, so I'm going to talk to you a little bit about the last 60 years of the building of this architecture that we're left with. It's been diagnosed as having all these kinds of frictions and all these issues. So how did we end up here as that system? I'm going to talk about chips. I'm going to talk about SWIFT, and I'm going to talk about CLS. There's a series of kind of issues, but it's really interesting for a historian because the underlying architecture of this system is persistent for about 150, 170, 200 years. And that's this mechanism of correspondent banking, of interlocked Vostro Nostro accounts being the ultimate venue for settlement finally. So the persistence of this, and you could call it a technology, I suppose, across the centuries, despite the huge technological and globalization and deglobalization, really lends it a particular historical interest if you're thinking about the evolution of institutions. Okay, so as I said, I'm going to talk a little bit. I'm going to reach back into the 19th century because I think as a historian, you want to hear something old. Then I'm going to be really focusing on the 1970s, CHIPS, SWIFT, and CLS, a little bit about the themes that we might bring out in terms of the public and private interests and how those have been displayed. And then I'll let you maybe talk more about the future of global payments with a bit of hints from me. So this is the correspondent banking model. And as you can see, it's a very kind of standard model where, you instruct your bank to pay a person in another country, and that goes through the payment system or directly through correspondent banking to your PIS that have kind of prompt the policy interests. And this is almost all the data that we have on the cross-border payment system. And this is value and volume of messages through SWIFT, are the orange and blue lines. But you can see that kind of telltale, steadily declining gray line. That's the number of bilateral correspondence in the system, active correspondence, bank connections. And you can see that that's been declining since 2012. As I said, this is the only data they have. So as a historian, I'm ready to kind of fill the gap a little bit here. And it's really only since 2012 that we're able to track this particular measure of the system. And what's happening is that contraction is happening in the system, and it's happening unequally on a geographic basis. And so some regions, the Americas excluding North America, and you might think of, well, that's quite a lot of offshore financial centers in the Caribbean maybe, or the oceanic offshore island financial centers. But there's also the risk of being excluded, of populations being excluded from cheap, easy access to cross-border payments. I'm thinking particularly of remittances, but it's equally important for industries or firms that want to be involved in international trading. And there's been some initial research by Borchert and his co-authors in Central and Eastern Europe showing that when a local bank loses its SWIFT connection, the firms around that bank trade less. So it could have some real economy impact as well as the distribution. Okay, there is some literature on correspondent banking and some historical literature in particular, because the United States has its own correspondent banking system. And there's been a lot of work on how that influenced and was affected by the great crash in the 1930s and the banking failures, and to what extent that system of interlinked banks contributed or not to the extent of the crisis. There's been a little bit of historical work on the international dimension of correspondent banking, but again, the data has been quite difficult to get hold of. At the time, people were a bit worried about it. So that's just some references there. And of course, since 2020, there's been an increased policy interest that has sparked some new research. Okay, so in terms of the evolution of structures, this is where I'm going to drop you back into the 19th century. We can think of this evolution as going through a series of stages or a series of innovations. You've got the bills of exchange, letters of credit, your Vostro Nostro. You've got branches and agencies, and then you've also got this firm-to-firm, crossing the firm boundary correspondent banking relationships, where the risks are not able to be internalized into a banking network. So here we have a bill of exchange, and these are probably the funnest technologies ever. This is a bill of exchange drawn on Oriental Banking Corporation, which is a bank registered in London, that has no British depositors really. It's a British, what was called a British overseas bank. So it's only kind of doing business outside Britain. It's written in Shanghai. The acceptor and guarantor is in Lyon. We can think this is associated with the silk trade in the 1870s. You've got an 8 months maturity, so there's a credit element in this payments document. And the credit element of bills of exchange have been hugely studied. But less well studied is that this is also a payments and a settlement instrument. We think about the platforms of communication. So payments are communications in the end. And so these bills of exchange would be posted, or the details would be telegraphed, eventually into computer hub and spoke digital networks, and now into distributed ledgers. But in each case, the technology is pushing for something important, pushing for that transparency for the users, for speed, for minimizing cost. And that includes having sort of codes. So here's some old maps again. So this is a history talk for you. And this is just showing you some of the major telegraph routes in 1891. The telegraph, particularly the transatlantic telegraph, is sort of an 1860s, 1870s kind of event or phenomenon. And it was associated then with the first globalization of trade payments and migration flows. By 1901, you've got a more complex, you've got these multiple links. These are all telegraph cables crossing particularly the Atlantic, but also into South America, East Asia, into North Africa, and across to South Africa. And this is the cables, submarine cables in 2022, the fiber optic cables that follow very similarly the lines of those 19th century transitions. And this is the kind of cables that carry our communications, including SWIFT. So again, there's an entrenchment there. There's a historical echo there in how the structure, geographic structure, as well as the ideological structure has been formed. Okay, so I've couched this in terms of public and private interest, because doing payments can be a very lucrative part of what it is that banks do. It can generate some liquidity. You can get quite large fees. You do cross-selling of other kinds of products. So there's quite a lot in it. And then on the other hand, there's quite a lot of public interest also that this system functions for populations, that it functions for business, it functions for economic purposes, but also that if it all goes wrong and it springs a leak, who is going to be the backstop for this system? And there has also been a waxing and waning of that shift between public and private interests. So in the first globalization, we started with it all in the private sector. This was the business of banks. This was the accepted business of banks. This was a time when central banks did not really regulate and monitor what their banks were doing very much. That really wasn't in the mandate of central bank. The post and telegraph, however, were often publicly owned. So the rails were often rented from the state. And indeed, the Bank of England by 1914 ended up being sort of a lender of last resort by opening up its discount market when the bills market was in trouble. So there's a bit of a lender of last resort backstop. So it's not completely in the private sector. In the interwar period, so after the First World War, you see sort of a nationalization of cross-border payments. And this has to do with balance of payments constraints with wars, where central banks took control of private cross-border payments, and they delegated the monitoring and the functioning of that to their private sector banks. So there's a lot of bilateral payments agreements. We had to kind of bilaterally balance payments over a period, and exchange controls in the post-Second World War period is another kind of form of control. And then in the 1960s and into the 1970s, you see it move much back further and firmer into the private sector through settlement and messaging that we'll talk about in a moment. And there's a bunch of kind of pressures here, and I'm repeating them a little bit to keep them in your mind. One of them is the role of technology. So the communications technology is really vital to this industry. It can be very experimental. It's very expensive at the start. Staff costs, getting skilled labor into these innovations is very expensive, as you've probably experienced over the last few years. There's a role of ideology, that this is the fundamental bread and butter of what banks do, is they make payments on behalf of their customers. and therefore it rests with them, the responsibility for that, which is a good argument. But there's also coordination problems in the cross-border context that, again, I'm sure you're all aware of. The inability to kind of harmonize across currency borders, but also the primacy of the national mandate of central banks constrains the ability to coordinate more imaginative responses. Okay, the context for the 1960s and 1970s, and again, Hélène touched on this a little bit, is the surge in offshore payments, the surge in the euro-dollar market, particularly hosted in London. And this integrates the cross-border payment system in a way that escapes the exchange controls that have been imposed, particularly on current and capital account transactions. There's a big kind of weird panic, almost like a moral panic towards the middle of the 1960s. People are expecting European integration to intensify, to have a banking union. We know that doesn't happen for another 20 or 30 or 40 years, if at all. But they're thinking and anticipating this kind of real tight integration. So they throw out all kinds of branches into weird and wonderful places that they don't know much about. They open up subsidiaries. And another strategy is that they group together and they form these sort of banking consortia to try to carve up the world and share knowledge. And it's in these groups of banks rather than through mergers and acquisitions that a lot of the design for the cross-border payments and standardizing of those payments happens. There's new market risk. Nobody under the age of 60 had ever had a floating exchange rate or operated a floating exchange rate in a foreign exchange market by the time it comes along in the 1970s. So this is a really big shock. There's an operational risk. It's all paper-based, and then there's the paper crush. And there's also operational risk in that banks are busy internationalizing, having gone through this quite fallow period of paying attention to their domestic knitting. And there's a lot of weak internal controls. Their managements are overstretched, and there's a lot of rogue trading crises and quite fun stuff that happens in the early 1970s. This is kind of what correspondent banking looked like. So this is maybe your know your customer part. It was a very personal sort of enterprise. So this is the Chase man. You know, he's out there. He's kind of a burly American guy. He's coming out of a London taxi to a slightly weedy looking English banker. It looks like a very gray day. But this is advertising, and the Daily Telegraph, which is sort of a conservative businessman, might have used it and read that newspaper in the mornings before they read the Financial Times or something like that. It was a very personal kind of business. So you were out there trying to know your correspondent, what kind of business they were doing. It goes beyond their balance sheet to they'd be visiting them and seeing their offices. It's what in 2000 was described by a correspondent banker who was describing how he got clients at the Cayman Islands as a knife and fork kind of business, where you went and then you went for lunch in the Cayman Islands, and then you kind of went off and played golf, probably had a few drinks, signed everybody up, and went home. But that kind of personal connection of banking is something that I think we should keep hold of. Okay, so moving to the clearinghouse interbank payment system. So this was the United States dollar settlement system. It was sort of founded amongst the clearinghouse banks in New York, who were the main correspondent banks for all US dollar payments globally. And it's sort of demand-driven in 1970. And part of it is that you've got these messengers with their interbank checks cycling down Wall Street and to the clearinghouse and 3 or 4 times a day. But most of them are showing up just before 5 o'clock, so it's not very efficient. This is a quote from the archives of the Reserve Bank of New York. Crowley, this guy sort of reporting to his boss about the really dramatic change that has happened in the nature of this business by 1970. There's a technological innovation. There's computers that we can suddenly use. So that's applied. And they get this system of sort of entering it all throughout the day. Then there's a final clearing. Everybody has 30 minutes to settle, and you settle through the Reserve Bank of New York. But there's a lot of gatekeeping here. So it's only clearinghouse members in New York, and they can then have associate members who clear through them for a fee. And similarly with foreign banks aren't allowed in directly either. So the EDGE Act subsidiaries only get direct access. And it's a huge success. And you can see this in the total value of transactions in your top left-hand panel. If you kind of look at it in different sorts of ways, though, the dynamics are quite different. I'm going to come to the average dollar amount per payment in a moment. You can see that the total value relative to US GDP or to world merchandise trade sort of peaks in the 1990s. And it's in that period that you see much more netting. And so the volume or the value of transactions that is actually going through chips then declines. And you can see this maybe as an increased efficiency of the system. Okay, but it doesn't function very well at the start. As I said, most banks don't have any direct access. All the foreign exchange payments are made immediately, but the matching dollars aren't available until the next day. These are clearinghouse funds. So there's this kind of long gap between payment and settlement. Friday funds, if you manage to do your stuff on a Friday and get the money in, well, then you can put it in the markets until Monday. So again, there's an incentive not to have this be a very speedy sort of function. There's a lot of daylight overdrafts. So as I said, all the money is going out before the money has come in. And then there's this really critical time change between what's happening in New York and the rest of the world. So again, this is a quote from the archives. He's trying to explain to his boss what's going on. And it's a business in which trust and confidence is essential. And we'll see that trust and confidence evaporated quite suddenly in July 1974 with the collapse of Herstatt Bank. So I think most of you will be familiar with Herstatt risk and the story of the Herstatt Bank. It was a fraudulent bank. I'd point out that everybody knew it was a bad bank. The Bank of England and the Federal Reserve, or the Bank of England and the Deutsche Bundesbank had been in correspondence about it, and they've been warning each other, this bank's really in trouble. The owners have been hauled over the coals a couple of times. In the market, it's clear in the archives that other banks, their counterparties, kind of knew it wasn't a very good bet, and a lot of people withdrew from dealing with them. So it's not really a huge surprise as it might have seemed from the outside. But what it does is that it exposes that counterparty risk in chips. And Chase Manhattan is the correspondent bank in New York for Herstatt. And as soon as it closes in Germany, but the markets are still open in New York. So a lot of people are out of funds. And the whole global dollar system freezes in 1974. So this is July 1974. We've already kind of gone through, we're after the oil crisis and the kind of huge surge in the euro dollar market and everything. And suddenly trust evaporates and is taken out of the system. And nobody wants to clear anything until they have the funds firmly in their own accounts. And it takes quite a lot of maneuvering by the Federal Reserve in order to get the market going again. What's interesting is there's a sharp fall in the average size of payments. So you can see that's going up quite nicely and everybody's feeling confident and excited about chips. And then it falls back again. But what's important to note is that it doesn't recover the average value until 1986. And think about what's going on with inflation during the 1970s. So the real value is shrinking really, really rapidly. And this is before you've got much netting happening. So it's in a sense that the Herstatt crisis, and we hear about Herstatt risk and how to get rid of it, but it has quite a profound and lasting impact on the global payment system. Okay, and as I said, the Federal Reserve then gets involved. And again, this is detail that's difficult to get unless you look in the archives to see the negotiations and the letters and the correspondence between the chips and the banks and the Federal Reserve or the Reserve Bank of New York. But underneath the hood of everything's going to be okay, folks, don't worry here, nothing to see here, is quite a lot of maneuvering between the central bank and chips itself, quite a lot of political pressure outside the system because Congress is very anti-Fed at the moment. There's quite a big conflict between the administration in Washington and the Federal Reserve in Washington. And so there's quite a lot of pressure to stop FedWire competing with chips. So it kind of exposes this public and private tensions. It also draws in a lot of multilateral oversight, and I'm going to talk about that in more detail in a moment. And central bankers look inward and say, well, what can we do to make this system more robust? And how can we move to real-time gross settlement, which is their way to kind of fix what they can. I should say that there's chips in New York, and then there's chaps, the chips and the chaps in London. The head of CHIPS, this guy Lee, he comes over in 1971 to London and says, hey, we're CHIPS and we're going to set up our own clearing system here in London, and isn't going to be marvelous for you to have our services. And this really galvanizes the banks in the city of London to try to come up with something themselves. So from the 1970s onward, they're trying to kind of come up with a London clearing similar to what's going on in New York. They fail over and over again. I can talk about that a little bit later. It takes them about 15 years to get going. And I think this has important impact on the distribution of payments and where they're located. The fact that New York has really an unrivaled system for settlement. And in the end, in 2017, the private sector chaps is taken over by the Bank of England. Okay, so how are we going to get rid of this terrible problem of the Herstatt risk? Well, we need to have multilateral clearing. We need to have it happen faster. So there's quite a lot of schemes to come up with how to resolve this, and they're all in the private sector. So there's FXNet and ValueNet to try to kind of set up bilateral clearing, bilateral netting systems. SWIFT gets involved and has its own Accord product. There's multilateral netting, however, as we've all seen with multilateral payment settlement on a cross-border basis, is really, really challenging. And in the end, there are two private sector industry initiatives, one in Europe and one in the United States and Canada, that's trying to do everything for the world, ECHO and Multinet. And so the archives are full of the leaders of ECHO and Multinet kind of touring the central banks and trying to sell their products and sell their vision for how this might happen. There's a lot of problems, however. They really have trouble with the computers. These early computers are problematic, but they're even more importantly and lastingly, we have the jurisdictional problems of when is settlement final, and the law varies across different jurisdictions, how to enforce the contracts that are associated with them. How are we going to manage minimum liquidity and make it an affordable thing to be doing, and yet be robust to the failure of maybe the largest or the two largest participants in the system? So do we have a central counterparty, or do we somehow distribute it across the members? So there's all these different models. In the end, Lamfalussy minimum standards, the BIS committee comes up with sort of what the central bankers would like to see in any multilateral settlement system. But it's clear that the bankers are neglecting their foreign exchange risk. So we hear a lot about Herstatt risk and that it's this absolute nightmare, you know, in the minds of bankers. But in fact, it's very, very it doesn't seem to be high on the agenda. There's a lot of urging coming from meetings between BIS and central bank officials and their banking systems. You guys have to get your act together, please. You know, you need to do this. And in the end, it's threats rather than cajoling that leads to CLS. So this is just showing you this. So one of the things they were hoping to do is, well, if we go and survey and tell the bankers how terrible the problem is, surely then they'll solve it. So these are quite nice surveys of how long it takes. They do kind of a bunch of them actually, how long it takes between the cancellation deadline and actual receipt of the funds. And this is all funds against the US dollar. And so you can see it varies really widely. I'm kind of struck that there's any time at all. And who are the 8% of banks for whom it takes more than 48 hours to settle between the Canadian dollar and the US dollar? Would be interesting to know. But this is in 1996, so you're now 22 years after the Herstatt collapse. And the BIS kind of goes in and looks at all the monitoring of foreign exchange risk and comes up with that 60% of banks are still underestimating their exposures. So it's a big problem. The banks on their own do not seem able to resolve it. They ask repeatedly, so the central bankers are repeatedly putting pressure on, but in the end, it's being threatened with regulatory capital that makes the difference. So the CLS is incorporated in 1997, gets going in 2002. It's only got 39 banks in it, 7 currencies. It's got 15 currencies now, but CLS is now clearing a shrinking proportion of global cross-border payments because of it's excluding some key and important currencies, the renminbi, for example. So it's not a solution, I guess, to the it's not the end of the story for how to get away from these fundamental flaws. Okay, SWIFT is something that's quite trendy at the moment. And as I said, it's the only data that people seem to have on a systematic, even regional geographic basis to work with. It's messaging, not payments. That's what everybody says, it's messaging, but not settlement. But there is a bit of settlement in there embedded in the story. It takes a long time to get going. The banks start planning for it in 1969, and it launches in 1977. Herstatt Bank is a founding member, and so is Franklin National Bank, which also collapses spectacularly in 1974. Again, they're kind of in this world of we want to exploit network externalities, but on the other hand, we'd like to keep it all to ourselves, please. And there's a shortage of computing expertise. So again, if we think about the next generation of technological change and the way that everybody kind of felt like they were catching up maybe with distributed ledger technology as it was evolving in the later 2000s, it's a similar sort of story here with the computing expertise. It's scarce and it's expensive, and central banks can't afford it, can't afford the expertise. Okay, so this is kind of a jumble of a slide, I suppose, but it's just to point out some of the turning points in the archives. So they first start talking about, gosh, you know, I heard these banks are doing something about maybe a common messaging system or something like that. Does anybody know about it? And the first place that they talk about it is this BIS, Meeting of Experts in Computing. So you can imagine what the BIS experts in computing kind of looked like in 1969. Okay, they're not the high-flying investment bankers of the world. They're not very high up in their national central banks either. It's quite a humble sort of group. But that's where the whole kind of BIS CPMI thing starts. And so they initially think, well, the BIS thinks, well, maybe we can step in. We're called the Bank for International Settlements, after all. So maybe we could bring our expertise and provide an intercentral bank payments settlement and clearing. And that gets shot down for various reasons. The Banque de France, the Reserve Bank of New York, the National Bank of Belgium, they're all really, really concerned and think that central bankers really need to have an input into how this system gets designed, because it's going to have really important implications for how the international money system operates, and therefore possibly on our national monetary policies. But in the end, it's kind of debated and abandoned, particularly the Reserve Bank of New York and the Federal Reserve retreats. The Bank of England, the host of the largest foreign exchange market in the world, is absolutely not interested in any kind of central bank involvement. The central banks say, okay, well, if we can't design it ourselves and we can't really have a lot of input, could we at least be on the industry steering committees that are designing this system? And they send letters out and please, can we sit, you know, in the sidelines or something? And the banks say, no, sorry, you're not welcome. And then they go, oh, darn, you know, what are we going to do now, sort of thing. So it's a really interesting set of correspondence and internal meetings and hand-wringing about what to do with this new innovation. And in the end, central banks are only allowed to join on the same basis as any other commercial bank. Okay, well, I'll leave it there. The other column is sort of what's going on in the private sector. And it doesn't start very well either. Okay, maybe that's not a surprise. It's a very ambitious project. But it's a very ambitious project in a field of banking that is not very glamorous, that's very back office stuff, that does not attract very high salaries, that does not attract a lot of attention. It's just the bread and butter. I mean, even women have to do it in sort of back offices somewhere. That's how lowly paid and low caliber it is in the 1970s. So the people that are involved in this, that are nominated from the banks into the governance and management of SWIFT, are not the top caliber of the bankers of the banks themselves. And the central bankers are quite concerned about that. And there's a little bit of embezzlement and stuff at the start. There's quite a lot of fun stuff goes on. But more importantly, the rule book kind of keeps evolving. It's very uncertain what's going on. And, finality is the whole point of having a settlement. But it's quite complicated. And the governance, they get this nonprofit Brussels cooperative. The membership, there's a lot of benefits to being an early adopter. And then the incumbents kind of protect themselves. They decide, so there's internal meetings about which countries to let in next, and there's quite a lot of politics about that, as well as technological barriers to other countries joining. But it seems like a great success, so you get a lot of members joining, which is the orange line, and the number of transactions goes up, so that's lovely as well. You can see that the rate of growth year on year kind of falls, which is what you would expect, and there's only kind of 2 episodes where there's an actual decline in the number of messages that are being sent. I should say that the SWIFT data does not allow any idea really about the who's linked to whom. So there's no directional data in it. And for that, we need to collect other data. Okay, so thinking about the balance between public and private interest from this story, I'm arguing it's not necessarily a Darwinian sort of survival of the fittest, or we've ended up with the best we could possibly do. By being a historian, you're able to see some of the turning points, the decisions made, the decisions not taken, maybe the role of personalities, although I tend to abstract my own work from that a little bit, but how these institutions functioned and how they developed. There's a lot of inertia. There's a lot of barriers to entry. The interests of incumbents are protected. There's a lot of legal uncertainty. There's that tension between capturing rents and network externalities that plays out in developing a hierarchy within the system. It's not inevitable that payment systems are in the private sector. Fedwire did handle cross-border payments. CHAPS, as I said, was taken over by the Bank of England. The RTGS systems are obviously central bank run. Is it well that the public sector gave rather benign neglect then, and they just kind of let many flowers flourish? And the archive suggests probably not. They were engaged, they were worried about it, they weren't able to break in to be very effective. And this is because payments was seen as the bread and butter business of banks and should stay there. That central banks could not attract IT skills that were of a quality to be in that innovative space. And that there's international coordination problems, as there always are and still are in all these sorts of cross-border negotiations. But again, what I'm stressing is this persistence of the underlying technology, despite all these kind of grand systems that are put in place in institutions, of this correspondent banking that the nostro-vostro accounts persists right through this period. Okay, I'm going to just move on a little bit, just to think a bit more forward-looking or more contemporary. I don't know if 2001 is maybe not contemporary. It is for me. So SWIFT is maybe a private instrument of public policy. So after 9/11, as we all know, I suppose, the U.S. started to DOJ started to secretly subpoena the SWIFT records. And apparently they didn't tell anybody, and it was all very privately done. The story broke only publicly 5 years later in 2006. But some information had been shared with EU central banks, but they had not shared that information with their political partners. So it generated quite a big legal conflict between the United States and the European Union over GDPR. And one of the outcomes in 2006 is, well, SWIFT says, okay, well, we need to move some stuff and give people options so they don't have to have a server in the United States. So that's when the Swiss server opens. I kind of like this quote from Treasury Undersecretary Levy, who says he sat down with these every morning and he can't remember a day when they didn't get a really good outcome to trace some terrorist or other. And certainly there's then a catalog of people who were exposed. In 2012, of course, you have the Iranian financial sanctions. That's the first kind of SWIFT pulling the plug on a country's banks, or in most of the country's banks. But again, it's not something that has a kind of a really broad consensus, in the way that historically The United States has been using the US dollar for financial sanctions in the modern times from 1950, when they pulled the plug and refused to allow any or froze all the US dollar accounts around the world of Chinese nationals unless they could prove that they weren't associated with the Chinese Communist Party. So they have a very kind of strong bent to use the US dollar and to use financial sanctions. London and Europe have a strong bent not to do that. So there's often a lack of cooperation and coordination, as there was in this case. But in 2012 is when the Chinese start to think about their own system. And again, we think about sanctions as potentially causing fragmentation. And then in 2022, in response to the Russian invasion of Ukraine. I wanted to look back a little bit. So again, as I was saying, there's no national data on SWIFT available at the moment before 2012. So I've kind of scraped national data back to 1984. And this just gives you a sense of maybe SWIFT connections in the conflict zones of the Middle East. And the blue line is Iran, I think. And you can see that the first Treasury sanctions, there's not really much of an impact on the number of institutions connected in Iran. And indeed, the second round of sanctions doesn't seem to have a big effect. Iraq, gosh, the number of participants there increases really dramatically during the war period. So it's an interesting kind of tale, and we'd have to unpick some of what's going on there. But if you look at the volume of messages, and again, there's no data on value by country, but you can think about the volume of messages, there is some indicators, and you can see clearly that particularly that second episode of US Treasury sanctions leading to a reduction of the number of messages, the volume of messages being sent to and from Iran before the plug is pulled in 2012 at the end of that period. But nothing really obvious for the other countries. Thinking about China and Russia, so I've put all the bricks in there just to give you a sense of scale for Brazil and India are the two lines on the bottom. And then Russia is the green line. Russia joins after the collapse of the Soviet Union, and they've got this kind of weird banking strategy of the mushrooming of banks. And so there's a huge surge in the number of connections in Russia. At the same time, you have the opening up and acceleration of opening up of China over time, and the redistribution of international activity across banks and the increase in joint stock banks. So again, you're seeing an increase in the number of users also for China. But that collapses for Russia after the invasion of Crimea in 2014 is when you see that turning. And this is the number of SWIFT messages. And again, we can't do anything because we don't know the value at the moment. But this is sort of the sense of the volume of traffic, if you like. And you can see you've got that, if you can remember, the huge kind of ski slope that goes down for Russian membership. And you do see that shock to the number of messages, the volume of traffic after 2014, after the invasion of Crimea, but it bounces right back. Very, very quickly, whereas the number of participants does not. And then what's interesting in this picture is the diametrically opposed surge for the volume of messages from China and collapse of those for Russia after the sanctions of 2022. Not to zero, because not all the banks are pulled out. Remember that the sanctions are incomplete. So that makes us think about China. And I've told you, I think, that the renminbi is not a currency that can be settled through CLS, for example, although the Hong Kong dollar is. And this is just showing you the yuan share of the value of SWIFT payments, which is available. It's pretty small, is one thing to think about. So it's starting that first start in 2020, January 2020, is 1.5% of total value of SWIFT messages is in renminbi or yuan. And that's pretty steady, and it does rise up and surge up in the middle of 2023 at the time when the sanctions are starting to bite. But what goes up also comes down. And 24, 25, there were increasing threats from the American authorities against Chinese, potentially sanctioning Chinese banks if they were found to be facilitating Russian trade. Okay, so maybe China's the big fragmentation. And I'm thinking, yeah, but maybe no. So we need to keep the volume and the value of these transactions in mind, and the geography and the functioning of this system. It uses SWIFT. I think that's an important thing to think, and they're kind of developing their own language, but it's not completely disengaged from the global system. There's 194 direct participants. Only about 10 of those are not Chinese banks or banks in China. So that's another important thing to think about. It's not really an international system in that kind of SWIFty sort of way. You can then, this is the 2024 daily turnover, and you can see it's still pretty small in 2024, even though that was sort of a peak period for the renminbi denominated SWIFT data. Okay, and this again is maybe a bit more complicated, but what I'm trying to kind of argue is, well, the value and volume of SIPs, is it really increasing? Is it really changing that really quickly? Maybe not, or maybe we're at the start of a big swoop, but we're not there yet, is what I would say. So the first chart there is the number of transactions is the bars, and the value of transactions going through SIPs is the blue line. So there's not really much of an increase from 2024 to 2025. And again, it's a very Chinese bank-oriented system. So the line chart at the bottom shows you the large share of China as even in indirect participants. So these are participants in SIPs who would then clear through the direct participants. And they're also still predominantly Chinese banks. And in the bar chart at the top, the orange is all Asian banks, excluding China. So it's still very much an Asian sort of story in terms of numbers. And there's not a lot of change in the amount of European banks, for example, or the share of European banks in the system as a whole. Okay, so this brings us on to Hélène's paper, I suppose. So digital currencies as a means of exchange. They're offering speed, they're offering low cost, maybe transparency is a double-edged sword. On the one hand, you're on the DLT. On the other hand, nobody knows who you are. So it seems to get the benefits of transparency and privacy in balance. Remembering that the stablecoins borrow credibility from public money, and they anchor to a central bank money. Cheaper, faster, private. Are they scalable? I'd argue they are getting scalable, and they're getting scalable through indirect access through apps and other kinds of things that are make it easier, particularly on a retail basis for remittances and other things. She pointed to the challenges of knowing where exactly who's exactly is using Tether and what it's being used for, because it's all a bit opaque. But there are some studies coming out that suggest that Bitcoin is used as a vehicle currency, for example. If you kind of can track some of those transactions, that maybe up to 10% of Bitcoin transactions recently have been using it coming out of a fiat currency and back into a fiat currency. So that's a payment-y type of thing. And certainly we have a lot of anecdotal evidence and others about the use of Tether and Tether related apps for remittance traffic, which is the most expensive part of the global payment system. CBDC, you all know more about that than I do, obviously, but there's been all of these experiments, many experiments with many Latin and Greek names, none of which have really scaled too largely on a global basis. So we'll just see where that goes. And they run into the same problems as all the story that I've just told you from the 1960s about the governance, the harmonization, who supervises, where's the backstop, and who monitors it. Okay, so just in terms of public and private interests, just to kind of pull out these themes that I've been trying to talk about. I'm trying to get away from sort of a triumphalist story of, well, you know, we've ended up here and isn't it marvelous? It's not, and people woke up to that in 2020. But if they'd been historians and looked at it more deeply, they would have noticed that there were a lot of flaws, not only in the outcomes, but also in the design process. And understanding how these systems evolve, the role that governance has, the role that supervision has, the role that central bankers may have in the construction and the design of these systems is an important point to reflect on, I think, now that we seem to be moving beyond correspondent banking. This could be the end of correspondent banking, which would be tragic for me, but as a historian, I'll keep studying it. but the kind of only challenge to that that's coming forward now is the distributed ledger technology, which kind of gets away from the correspondent banking, and is one of the reasons why JP Morgan and other people the banks themselves are trying to capture back some of these systems for their own purposes. Okay, and I'll stop there, I think.
Thank you, Catherine. Now we're going to hear from Roland to give a real policy maker's response.
So how many minutes do I have? Okay, good. So Boris, first, thanks a lot for inviting me just for your farewell conference. Just 2 days before you leave to Frankfurt, right? So, and I heard quite a lot of Frankfurt bashing over the last 2 days. I mean, Michael Weber started complaining that the water is much colder than here. I think then there was a follow-up by Sandra claiming that there's a difference between water and seaside. And I think Marcello even alluded to potential distorted preferences in your case that you moved to Frankfurt. But I can reassure you that sometimes, not always, but sometimes Frankfurt gives you also a seaside feeling. And if you really feel homesick, you can do stand-up panic even in front of the ECB. So that, and if you don't believe me, you can ask Tobias Adrian, who happened to be, born in Frankfurt and raised there, and but lives in the United States. So, welcome to Frankfurt. So let me start my discussion of this, fascinating paper because it tracks developments in cross-border payment systems from 1969 to 99. From corresponding banking model to SWIFT and CLS. And I mean, Catherine does what probably every good historian, economic historian do is she's going really to the archives and provides kind of a lot of insights from the Bank of England, from the BIS, and also from Midland Bank. So there are, in a way, two core questions, the way I see the paper. The first is how did the system, so the cross-border payment system, respond to shocks in innovation? And the second one, how was the public-private boundary negotiated, right? And just very quickly summarizing and highlighting some of the messages in the paper. Of course, the 1970s reform, as you pointed out, Catherine, was a kind of a narrow scope. It was mainly focusing on messaging like SWIFT, and settlement stayed in a bilateral correspondent accounts for a long time, and actually it still does. And but the interesting thing was that the involvement of central banks was really contested. Some central banks pushed for involvement, but others resisted. And you find really like real treasures in the archives. There was this, I think you mentioned that, this meeting of computer experts at the BIS. And Catherine describes it very well, like a mixed enthusiasm by central banks to get involved in this project. And actually, once central bank, I'm not going to do name and shame, actually even said that actually we have no computer and we did not see that its operation would require one in the foreseeable future, right? So you see the starting point was like not particularly innovative in this regard. I think you made that point, which by the way, it shows that you have to be extremely careful what you're saying if the meetings are minuted, right? Because you might find it at some stage. And the other element that you are focusing on is, of course, the well-known famous Herstatt risk, right? Which, we have all learned exposed FX settlement risk. But what I always thought like, okay, CLS was founded because of the Herstatt risk, but actually I didn't know that it was like almost 30 years later at the end when it was addressed, right? So it took quite a lot of time. And it only worked at the end because it was plugged into public RTGS systems, right? So this private and public boundary and involvement is really important. So what the paper in a way shows, and that's the kind of my starting point of the discussion, that global payment infrastructure evolved through a contested compromise and partnership. So private actors led the design to improve efficiency and scale control, but actually ultimately payment architecture relied on public infrastructure, public support when systemic risk materialized, and that will be my admittedly a bit geeky focus, central bank reserves as the saved settlement asset. So ultimately, and I'm just paraphrasing an old Latin saying, which stated that all roads lead to Rome. Actually, all roads led to central banks and still do. And actually, during that time, as we all know, actually, they all led to the Fed New York. So all corresponding banking settlement was settled via New York because the dollar was the ultimate currency, and the corresponding banking model at the end required that you have an account at the Federal Reserve Bank of New York. So my discussion here is, again, is the central bank involvement. And the point that I would like to make is that actually the way how the payment infrastructure is set up is actually not neutral for monetary policy implementation. That's why central banks need to care about it. So monetary policy implementation and particular focus, of course, on central bank reserves. And there are two kind of different angles how one can look at central bank reserves. I mean, the first angle is in a way that the payment system, and that's a flow concept, kind of determines when, where, and how liquidity in the system ends up. And the stock angle is that monetary policy implementation is about the provision, so the stock of reserves, and of course about prices, because ultimately monetary policy implementation is the first phase of monetary policy transmission. So as payment systems become larger, faster, and more continuous, this interaction becomes stronger. Yeah, and I will provide you a few examples, and that's why central bankers need to be involved and need to be involved early enough in a discussion about the future a payment system architecture. Because, there are three questions. So does innovation in payment change the demand for central bank money? Does it affect the reliability of the monetary anchor? And ultimately, if we answer both with yes, potentially, when should central banks engage in shaping the payment infrastructure? So as I just said, my hypothesis here is that the rails, and you use this word plumbers, right? And there's this fantastic book, by the way, by Peter Norman that is called Plumbers and Visionaries. It's about the European settlement system, about the history. So it's really a fantastic book. So, in a way, our payment infrastructure persons, they call themselves the plumbers of the central bank. So it's not disrespectful in this regard. But the rails are, that's my point, are not neutral for monetary policy implementation. And there are at least 4 channels. So first, the timing. So faster settlement can shift liquidity needs intraday. Of course, we have systems that can address this. I mean, we have this intraday possibility of an intraday overdraft, both at the European Central Bank, but also at the Fed. But fast but there are issues about the operating hours, which I will allude to a bit later. And of course, location is also one of the issues. So cross-border links and longer operating hours move liquidity needs across systems. There's an issue about predictability. So fragmented payment system arrangements can make liquidity and demand challenging to forecast. And finally, transmission, because at the end, operational friction can spill over into money market conditions. So in a way, again, interaction between the payment infrastructure and the liquidity infrastructure, so ultimately monetary policy implementation, is really crucial. So let me just give you a very quick example based on what I would call kind of existing payment system architecture. So I'm not talking here yet about atomic settlement, which might change completely the dynamics here. I'm talking about instant payments and the demand for reserves. So high exposure to instant payments may create more volatile and less nettable flows because of the instancy of the payments, right? As you know, in many cases, we have in terms of deferred payments, we have the possibility to allow for net flows. In case of instant payment, this ability is certainly reduced. So if that's the case, this would make cash buffers more valuable, so potentially increasing the demand for reserve balances, which means ultimately, and it's kind of just, I mean, it's not a prediction, but it just kind of shows the impact of an increase in instant payments on a reserve demand. It shifts basically the demand curve to the right, so it's moving from the blue to the green curve in the chart. And there is evidence for that. There's evidence in the literature on the mechanism, for example, from the Brazilian instant payments PIX, that there are impacts on reserve demand coming from the introduction of instant payments. But the effect, of course, and here we are talking again about payment innovations, need not to be one way. So if payment information can also improve intraday liquidity, redistribution across banks, if we have new developments, for example, like intraday money markets. That's not the case yet, but I think in a world with atomic settlement, that's perfectly reasonable. All right. So do we have some evidence already in the data when we look at instant payments that we see that this is picking up, and we also see some implications on netting in the system? And if you look at our own TIPS, which is the ECB's own or the Eurosystem's own instant payment system, we do see some increase in the three currencies that are currently settled in TIPS, which is the euro, the Swedish krona, and the Danish krona. But what is also striking that when we look at money market transaction, we see that the share of T+1 settlement, so basically within 1 day, has significantly increased over time, while at the same time the nettable share have decreased. So we do see already in the existing systems, as the existing systems are developed further, and intraday instant payment picks up, we do see kind of a changing behavior of reserve flows. So what are the lessons, therefore, from history for kind of shaping the future? I mean, as Catherine, as you pointed out, and you made several examples in this regard, private actors often lead on efficiency and scale in these systems, right? I mean, coming back to the computing exercise, right, in the BIS. But public authorities are always thrown in when risk scale or public infrastructure is needed. So there is an interaction between the rails and monetary policy implementation. So to answer in a way, or to kind of add an additional perspective to the question, how this interaction between the private and public sector should look like in an optimal case, I think public sector and central bank involvement is indeed crucial. So what are the today's kind of focus in this regard? I mentioned already instant payments. They increase the liquidity needs potentially to settle in central bank money. And also it has interactions with longer RTGS hours because that potentially shifts liquidity across days and time zones. And here I think one element is of course important, and that's what we have looked at the ECB most recently, is that, of course, if you have a system of instant payments, but at the same time, the provision of liquidity by central banks is not 24/7, like in case of instant payments, there might be some frictions that need to be addressed going forward. So it is always a question about the operating hours of the existing systems. But there is a new element that, and you alluded to, I don't think you discussed that in the paper, but in your presentation, you alluded to new development that are related to tokenization. And of course, what we see now increasingly that we do have some forms of private settlement assets as stable coins, and I know there will be a panel later about that again reopens this question about the public and private boundaries, right? At the same time, my hypothesis here is that there is still a desire to settle in central bank money, because this is still considered by the private sector as a safest form of settlement asset. And this means that, again, the central banks need to look at these developments, and actually the Eurosystem is indeed engaging on many fronts here. So the one engagement that we are currently working on is certainly Pontes, and Pontes enables the settlement of tokenized wholesale transaction in central bank money, and this is kind of a short-term central bank project, allowing very soon actually to settle in central bank money in a tokenized world. And the other element, and that's much closer to the original discussion, which is not an IT project, sometimes it's considered to be an IT project, is APIA. Because APIA is actually a conceptual project that thinks about, in a way, the payment and financial architecture in a tokenized world, and what is the role of central banks in this world in order to ensure, coming back to my original question, that central bank money remains the monetary anchor in this system, right? And this will be an ongoing project, a very long-term project, because of course it has many dimensions, including also monetary policy implementation, but also involvement, as we might discuss later, implication also for monetary policy stance itself. So, of course, at the cross-border level, and your focus at the end was, of course, very much on the cross-border dimension, we see similar developments here as well. We see, I think, Helen kind of alluded to that, to the project of Agora by the BIS, which is a public-private sector partnership for wholesale cross-border payments in a tokenized world, where actually this kind of corresponding banking model is aimed to be translated into this tokenized world. So thank you very much for having the opportunity to discussing this interesting paper. Again, my main point here is that central bankers, the public sector, needs to be involved early enough in these developments, because there are serious interaction and spillovers between how actually the rails are set up and how monetary policy potentially can be implemented. Thank you very much.
Thank you, Roland. Oh, wow. Okay. I told you there would be questions. We do have a few minutes. So let's take a bunch. I think there's two here in the front, please. And the red shirt.
Thanks so much. By the way, Catherine, completely fascinating research. Makes you make us think that, the president did not arrive here randomly. So there's a whole history to explain where you are, and it's completely fascinating. I want to take a little bit of exception with Roland's comment, and also what's implied in your presentation, that the role of the public sector, of the central bank, comes through the importance when it comes to the operation of monetary policy. I do think there is a case for efficiency as well, for public sector involvement. And I may be making some members of the IF unhappy when I say that. But if you just gave the example of PIX in Brazil, which is a central bank-led payment system. And as a citizen of Brazil and as a citizen of the United States, I cannot tell you the world difference in payments. Any payment to any transaction, person to bank, person to person, is settled in Brazil in 5 seconds. Just last week, I had to pay for inscription of a conference in the United States. I could not do electronically. At the end of the day, I had to send a check. So the difference is huge. And this debate is part of the policy debate now with in the US, with the private banks who want to take the lead on this transformation that you are seeing through digital forces, and then question the role of the Fed. I don't know if Chris has an issue with that. But it seems like it's a case of externality, and the public authority would have a role for efficiency reason. And the banks in Brazil benefited tremendously from PIX with an increase in bancarization and all that. And you give an example of Project Agora, which we are very involved, where you can bring to another level and say what you need is better collaboration. And Project Agora is a good example of public-private partnership. But anyway, I think there's an efficiency case for public sector intervention as well.
Can we have Helga and then thanks.
Fascinating. Thank you for this. You illustrated that geopolitical developments historically and in the present have an impact on the way these international payment systems work. How persistent are they, right? And what would I learn from history about the current fragmentation around China, for example, the focus on renminbi-only trade? Will this last, or will this go away again, for efficiency reasons?
Take one more.
Thank you. It seems to me that it's self-evident that the international payment system in particular is a great example of a public good. It's as much a public good as a tunnel would be under a river. And then listening to this history, I'm sort of puzzled about why that realization has not taken place. on the part of either international community, domestic central banks, or even the banking community. And I'm sort of curious about what you think about where we might finger the blame. Is it the private banking sector keeping control of the rents it gains from the fragmentation that exists? Or is it, in an international sense, the unwillingness or the fear that central banks have with international cooperation? That doesn't explain the domestic American fragmentation. Why is it taken so long in this example, in this industry, for the public good aspect to be recognized by both the public sector and the private sector?
Do you want to both come in on those three?
Right. This is, yeah. Well, thanks for that. And thank you for your comments. And some of the things you were talking about, for example, the timing overlap of RTGS, the extension of opening hours and stuff, that became a very big part of what was going on at the BIS from the 1990s onward. So it's interesting to hear it raised as still an issue going forward. Similarly, the central bankers, when they were looking at SWIFT and whether they should be becoming more involved in the 1970s, it was a group led by the Bank of England, the Banque d'Italia, and I think the Banque Belge, who were set to set up a working party to decide whether there were any monetary policy implications of what SWIFT was planning. And their conclusion was that no, there wasn't, because there was no clearing. As long as there was no clearing, then, and if it was just messaging, that was fine. We know, however, that there's quite a lot of slippage between netting and clearing in SWIFT and how that functioned. And indeed, very soon after, in the 1980s, the SWIFT became the clearing agent for the private ECU market, for example. So there's a bit of slippage there. But again, a historical echo. The other echo I would say is that when CHIPS shifted closer to, or tried to reduce its intraday risk, and there were some changes and regulatory changes that happened in the 1970s and 1980s, there's a really dramatic change in the commercial bank balance sheets as a result. So that is worth looking at again as sort of the impact. How persistent is the fragmentation? We'll have to wait and see. I'd say it's not as fragmented as it might seem at the moment. So I'm still quite bullish about the dollar as an international currency, as you might be able to tell. I don't think the yuan is ready to go. I don't think the euro is ready to go. I'm with Barry Eichengreen on that. They're not ready for prime time. But I think the innovation in other payments is growing faster than I would have anticipated. I was quite down on stable coins and crypto probably about 3 years ago and thinking, oh, it's never gonna take off and it's not gonna be scalable and this sort of thing. But I think we need to also separate out the retail versus wholesale markets as well. And the real kind of crux of inequality is a lot of that is at a retail level, remittance level. And if crypto, DLT, or stable coins can overcome some of those frictions, I think that would be a good thing. So I'm feeling a bit more positive about that. Why has nobody listened to me? Is this what you're trying to say? I think there is certainly, looking at the archives, and I would not encourage you to hold back in meetings, as Roland suggested, for fear of posterity. But looking at sort of those internal discussions, there's a huge nervousness, and there's a nervousness not only about somebody's going to have to be the backstop, and we can't coordinate that amongst ourselves as central bankers. But also that relationship between central bankers and their constituent commercial banks is quite close as well, and they share a lot of interests. So that's another sort of form of capture that happens, particularly in the 1970s, I think. And so they don't want to be seen to be eating their bank's lunch. Because as I said, it's a very back office kind of thing, but it waxes and wanes in relative importance as a flow of income and a source of liquidity or liquid funds over time. The business model for for payments changes according to whether it's a high interest or a low interest environment, and what kind of margins you're able to make, maybe on the unrequited deposits that you're able to get, or the cross-selling of the fees and getting more foreign exchange business. So it's quite opaque in terms of where the revenues and the costs lie for this business, which is another thing to keep in mind. And I'll stop there.
Yeah, just, I mean, picking up your comments on efficiency, I mean, I couldn't agree more. I mean, we in Europe, we know very well that the discussion about the efficiency of our own payment systems has been an issue for years. I mean, you might recall the big discussion, which was not a big deal, actually, changing some numbers about SEPA, right? That created a lot of discussion in Europe, and it took, in a way, at the end, a public sector push in order to achieve that. My point was more, so I fully agree with that, but my point was more that even if we believe that the private sector can do everything very efficiently, right? So in a way, even then, we have to be careful in getting involved about the payment system architecture. In a way, it's, you remember the kind of a Sergeant Wallace paper about the neutrality of monetary policy implementation for the economy, which we know it's not entirely true when you deviate it. There's an equal theorem that at the end, the way how the rails are set up is non-neutral for monetary policy implementation, even if the private sector potentially are much more efficient or much. So we cannot be just bystanders and watch and see what happens. We need to be involved early enough.
Any other questions or comments? Ian, and then I'm going to add one and we'll wrap it.
Is it working? No, it's working, yes. A very quick one. The weaponization question. How seriously should we take it, and how accurate are the Belgian authorities to fear the weaponization of SWIFT?
Can I add any other questions? I'm going to just add one really quickly. So we've talked about fragmentation. I think I know where you stand on that, Catherine. We've talked about innovation, and we're going to come back to stablecoin and other areas later. My question is around resilience, which is an area of interest for this group. Does it depend more on standardization, like the evolution from the beginning has, or interoperability? And how should we think about that? So weaponization and that last question, and we'll wrap.
Right. Okay, so historians are notoriously bad at predicting the future, so I want to kind of couch that carefully, and you're the experts on a lot of this. What I would point out, though, is that the use of an international currency for political purposes through sanctions and other sorts of things has happened for quite a long time. And some have argued that this gives the Americans more power, that a country has more power by weaponizing its dollar. And now we're thinking that maybe this undermines the credibility of the US dollar and leads to other kinds of outcomes, because the balance more broadly of economic influence has changed. So the world is a different place now than it was in the 1950s, 1960s, 1970s, 1980s, and 1990s, when the dollar was used in financial sanctions. So that's one thing to kind of bear in mind. The weaponization of SWIFT also had happened before. And while we think of the Iranian episode in 2012 and after as being sort of a global consensus, it wasn't necessarily, and certainly the Europeans tried to find alternative ways, particularly to get humanitarian funds into Iran, and although it wasn't wonderfully successful. So we need to think about that as well. The use of SWIFT is not complete either. So I think that's the exclusion from SWIFT is not complete, is another thing to think about. In terms of resilience, I'm not sure standardization is the way, or interoperability. I mean, those. I guess you're thinking about sort of operational resilience rather than the ability to kind of resist a shock. Sort of more endogenous shock is important, and I would say that while I feel like I've given you a very kind of critical story about the evolution of these institutions. They have been resilient to these shocks. So CLS got through the whole Lehman's crisis, and they did get some help in order to kind of clear all those payments at the time. The other thing is, you can understand why bankers were worried so much about foreign exchange risk or Herstatt risk. They had BCCI collapse. They had Drexel Burnham. There had been kind of little blips of financial crises, and nothing really terrible happened. So you don't have a kind of a repeat of what happened in the Herstatt. So maybe amongst themselves, they had a sort of more ad hoc ability to resolve some of these issues. But again, that's happening during the Cold War. It's happening in a context where there's a lot more coherence and commitment to a single vision, or almost single vision, of what the international economy looks like, and that globalization is a good thing. And we're not in that world anymore.
Well, I mean, in terms of weaponization, I mean, I have not much to add. Of course, I mean, at the end, the question about exclusion or weaponization, it's a political decision in different jurisdictions. What we as a central banker have to make sure is that we are not vulnerable to these kind of risks, because at the end, the functioning of the payment system is key for the functioning of the financial system. So in a way, we are more like a plumbers, but in a way, a strategic plumbers, because we need to be kind of, we need to identify a potential risk related to that. But of course, again, as I just said, that's more or less a political decision that we have to take as given.
Okay, we know we stand between you and lunch. So thank you so much, Catherine, for your keynote. Thank you, Roland, for your discussion topic. And bon appetit, everyone.
So good afternoon. After the lunch, of course, it's a bad news and good news. Bad news is that after the lunch, it's always a tough panel. You have to stay awake. But the good news is that after this panel, you can go to the beach. And even the better news is that you have a fascinating panel here to continue discussing where Catherine stopped. No? She stopped pretty much asking herself whether her job as a historian is coming to an end because the digital means of payment will take over. There will be no more correspondent banking, etc. And this is a little bit something of which people around this table have to say because I will ask them how they see these things going forward. The title of the panel is Stablecoins and Monetary Policy, but it's actually broader. Some of people here will talk about the tokenized deposits. I will talk about the stablecoins. I will put a little bit more emphasis on the CBDC, as far as I understand. So these are different means of digital means of payment, basically, I would say, unified by the distributed ledger technology, but different options that we see in front of us. Now, I say if it was for the 300 billion US dollars of stable coins now, we would not have this panel because it's so small that it doesn't really deserve too much attention. And although it has risen, basically the amount of the stable coins doubled within the last 2 years, it's going from very small to still very small now. So what I would like to ask the panel is, imagine the world in which Catherine loses her job because we really get that many stablecoins or tokenized deposits, that it really changes the way that the payment system operate, but then it changes a lot more. It then changes probably the transmission mechanism of monetary policy to the banks to their clients. Maybe it changes the way we think about the zero lower bound. Maybe then it changes the architecture of the world international finance. It's not going to be what it used to be then, if it happens. So first question for my panelists will be, where do you see the digital means of payment in next 5 to 10 years? Do you believe that they will be irrelevant, or you think they will take over? And regardless of what you answer, then they'll ask you, imagine that they actually grow maybe more than Scott Bessent thinks they will. And what does it mean for bank-client relationship, demand for the safe assets, monetary policy transmission, etc. So who is here with us today? On my left, I'm starting from my left, David Alnofato from University of Miami, but former also Fed. And he likes the topic, I know. Megan, also good old friend, and also good old friend of this conference. Megan Green from the Bank of England. Chris Koff from the Union Investment, also not first time here. Brunel Rosa from the Rosa and Associates and Bocconi University. And last but not least, Chris Waller, who is a person that knows a lot about this topic and is in a way in charge of many things that we'll be talking about at the largest central bank in the and the most important central bank in the world. I have to say that, although I'm taking the new job on Monday, I have to say that. So, Chris. So, without further ado, you know where I want to go, and maybe David, we start with you, and then go.
How shall we start? Opening remarks?
Opening remarks, but try to answer my first question. Where do you see the digital means of payment in 5 to 10 years? Do you think that we are discussing something which will become really relevant, or we're gonna stay small?
Well, I think that in the conventional sphere, I think what you can see is a growing emergence, an effort to tokenize bank deposits, securities. I know I saw a recent talk by a representative from BNY. I mean, they're full on this. So I fully expect to see that sphere develop very rapidly. One question is whether or not these tokenized objects are going to be managed on in-house ledgers, or whether or not they'll be permitted, like a lot of the stable coins, to run off of these public blockchain rails. That's something I look out for. But in terms of whether or not these stable coins will ultimately grow sufficiently large to take over or become systemically important, I think it's worthwhile to just speculate. You know, as policymakers, we have to be prepared for all contingencies, even if they are unlikely. For myself, I see that the stable coins that are fall under Genius and MiCA compliant, I don't see much of an issue. My own concern is, you know, something like an offshore stablecoin, something like Tether, which happens to be the world's largest stablecoin. You know, as Helen pointed out yesterday in yesterday's luncheon talk, these entities like Tether are not directly subject to U.S. regulation. You can't tax them directly. You know, there are other ways to do this. And why would you want to do this in any case? I mean, I think you have to imagine of these worlds that might arise. You have to imagine, for example, that Tether grows in such a way that it starts to, you know, that it becomes an important way for firms along the global supply chain to finance their global payments along the global supply chain. I mean, that's not happening right now, but it's something that's not inconceivable. It's not something that might happen in the future. And then you have to ask, well, you know, what might possibly go wrong if Tether was to be, say, much larger, even though they've slowed down now, it might get much larger in the future. What could possibly go wrong? Well, we know we have examples of runs on kind of money market funds, like things that can go wrong. Tether's either going to defend its peg, or it's going to not defend its peg. As far as Tether is concerned, I don't think that Tether is legally obligated, legally or contractually obligated to redeem its liabilities at par and on demand. So I do believe Tether reserves the option to actually, you know, like any fixed currency regime, to revalue its currency, say at 90 cents on the dollar. We've seen this many times in the past. Alternatively, Tether might be interested in defending its reputation. It would have to sell off assets on like U.S. Treasury securities. This could happen off regular banking hours because you know, Tether operates 24/7. And then the question is, what could possibly happen? Tether holds a lot of U.S. Treasury securities. What if they start instructing their custodian to start selling these things off en masse? This would put the Fed in a very difficult position. You know, the optics would be terrible. And you can see the headlines right now. Governor Waller bails out unregulated shadow bank.
Ain't gonna happen, man.
So what can you do if you can't get them directly? I've advocated perhaps going indirectly, take the indirect route, you know, maybe go at their custodians, you know, perhaps insist that Cantor Fitzgerald adopt a more fiduciary type of role. Or perhaps even prohibit U.S. institutions from providing custody services for offshore entities like Tether. I mean, I think if that were to happen, I wonder if even Tether could even exist, you know, as a U.S. dollar-based coin. So anyways, that's my 2 cents worth on that.
Thanks, David. Megan.
Yeah, thanks. First of all, thanks for having me back at DEC. I love a conference where sunglasses are on my face or on my head almost all the time. Thank you. So thanks for having me back. I should also say these are very much not the views of the Bank of England. These are my views on digital assets. I think it's worth first asking what the point of them is. So what problem are we trying to solve? And to my mind, the problem we're trying to solve is to tokenize assets so that you can embed contracts into them, so that when you have a delivery of a product, all kinds of transactions are automatically set off, payments, margining, compliance, all of this in what's called an atomic settlement. Who doesn't like an atomic settlement? So I think that's the idea. It makes payments, and particularly cross-border payments, much faster. You know, these these settlements don't, they can happen on a Sunday. They don't have bank holidays. They can happen around the clock. So it's much faster. It's much cheaper. It also frees up a whole lot of liquidity. And to answer your question, Boris, even if you don't like these digital assets, like the ship is out of the harbor, they're here to stay. So I think it's worth engaging with them and thinking about the design. And when it comes to the design, I think the most important thing is the singleness of money, as Helene said yesterday at lunch. So, one stable coin is $1 back stable coin is worth the same as a central bank dollar, which is worth the same as cash. That they can all be interchanged. So that, as a central banker, I think is paramount. But when it comes to the design of these and which ones are going to take off or not, I like to think of it as a massive race between the tortoise, the hare, and the rhino, I'll say. So the tortoise is a central bank digital currency, a wholesale one. The hare is stable coins, and the rhino is tokenized deposits, in my view. And I think we'll probably end up with all three. But if I had to put my money in one, no pun intended, it would probably be the rhino, actually. So tokenized deposits, which I think will probably take off. I'll just go through some pros and cons of each quickly, and we can talk more about it in the next round. But when it comes to a central bank digital currency, obviously the biggest pro is that central bank money is the safest asset there is. So you have no credit or settlement risk whatsoever. It plugs right into the existing banking system, so that speeds up its development to some degree. You have anti-money laundering and know your customer protocols that still exist. There are a couple cons, though. For those of us who work at central banks, we know they're massive bureaucracies and don't tend to do stuff quickly. So even the digital euro, which you guys have been working on for years, probably won't come into existence until 2029 in the face of a pretty immediate threat. I mean, you don't hear digital euro without strategic autonomy in the same sentence. So even in the face of a pretty urgent threat, it's going to take another 3 years. And it could pull deposits out of the banking system, which obviously kills off banks' business models. But central banks don't know how to evaluate loans and things like that. We need banks to do that. So depending on the design, I think that's a risk. Stablecoins, which are the hare in my Aesop's fable, are backed one-to-one by real assets. They weren't really going anywhere until the U.S. government threw all of their weight behind stablecoins. And now they've really taken off. About 98% of stablecoins are backed by dollar assets. They do all the things that I said at the beginning was the goal of digital assets. So they speed up transactions. It frees up liquidity potentially. It's developed by the private sector, so it's coming along much faster. Commercial banks are putting tons of money into the infrastructure around it. The biggest con to my mind is that stable coins are just not all that stable, which I think is an issue. There's a question about what exactly is backing them, where it's regulated. Tether's based in El Salvador. How are we going to regulate that? In the US, there's some state level oversight, and there you get states actually competing with each other to attract stable coins. So my understanding is that Wyoming's becoming kind of the Rhode Island of stable coins, where they've got a lighter touch regulation, which is worrisome. And it also, it affects the monetary transmission mechanism. If we're no longer operating through banks, it weakens the sovereign monetary authority. I think of the three, if the point is, or what's paramount is maintaining the singleness of money, it's the hardest to do with this one. You can regulate it. So the Bank of England has actually made an attempt to regulate it. In fact, the Bank of England's created an entire ecosystem for pound-backed stablecoins, which don't really exist. So we've created the ecosystem in the hopes that it will come. But according to our regulation, for a systemically important stablecoin, they have to stick 40% of their backing assets at the Bank of England, not making any money at all. And the other 60% can be in short-term government debt. My colleague tells me one of the crypto exchanges took out an ad on the tube in London against this. They're so livid about 40% not making any money. So I don't know that we've nailed it when it comes to the regulation, but I think that's a huge problem. Most of the illicit transactions in the crypto environment involve stablecoins. So it's an on-off ramp for crypto. I think it will remain such. But I actually don't think that that's where the future is going to be because of the problems that I mentioned. I think that these are going to be overtaken by tokenized deposits, probably. They're just digital representations of traditional bank deposits issued by regulated banks. So we get to keep all the lessons we've learned from previous financial crises. Anti-money laundering, know your customers still intact. The user experience doesn't really change. The problem is they haven't really taken off. In my mind, I think they haven't taken off because commercial banks don't want to lose the fees that they're getting, but I think they're probably going to lose them anyhow. And once they realize this, actually, they will put more into developing these. Helen also mentioned there ends up being liquidity fragmentation. So if you're using one bank's digital tokenized deposits, you can't really jump over into another bank's system. There are a lot of efforts to try to fix that. And that's not a small con. I'm not overlooking that, but I do think we'll get over that. And so, like I said, I think we're likely to end up with all three globally, but I think tokenized deposits are probably going to take over stablecoins. And in 5 years from now, I suspect we might wonder why we were talking about stablecoins so much.
Okay. Thank you. Pretty clear where you are on that. Chris?
Yeah, I actually prepared some slides. So my answer to Boris' question is on slide number 9, just to get prepared. Last year, we spoke about CBDCs here. That is on the left-hand side of that chart. This year, we're talking about stablecoins. And stablecoins, in my view, are not currency. They're assets. So we'll get to it later. And just to show you where the biggest stablecoins out there is Tether. Then we have a Circle. And there is a European initiative called Q-Valis, which is starting to issue a stablecoin as well. These are reserve assets meant to keep a peg to a currency, but they're not a currency. And as currencies, they're also not interest-bearing. The alternative, as Megan has pointed out, are tokenized bank deposits. We've got the JP Morgan dollar, and we've got the Great British Tokenized Deposits, GBTD, which are in the making. So that is the new thing out there. The death of CBDCs in the United States. The guy at the Fed who was responsible for that, Mark Gold, has resigned. And in Europe, they failed. The rapporteur at the European Parliament who tried to slow down and prevent the introduction of CBDCs has changed his mind. So alternative to crypto assets, so they basically stopped it and took control of Congress and of administration to stop CBDCs. So that's the state of play on CBDCs. Now, here you look at stablecoins. As Boris has mentioned, they've seen a good growth, but interestingly enough, since October last year, they stopped growing. Which already may indicate that there is very limited use to stablecoins. We're talking about 300 billion, and that market is not growing. It's a duopoly with Tether and Circle basically sharing almost the entire market. On the right-hand side here, you can see euro stablecoins, total market cap 500 million. It is the Circle in euro. That's the only euro-denominated stablecoin I could find. So according to my numbers, 99.8% of stablecoins are dollar-denominated, and there is only a very small portion which is euro-denominated. And on the left-hand side, you can see the dominance of the stablecoin market by Tether and by Circle, both in terms of market cap and in terms of transaction volume. So we basically have two coins that dominate the market, and the euro market is not present. It doesn't exist. There is no stablecoin market in Europe. So, I mean, I can already say why this is not the case. What are the main use cases for stablecoins? First of all, is digital or crypto native people who want to trade in and out of Bitcoin, and they don't want to go back into dollar deposits, so they want something equivalent to dollar deposits, so they go into stablecoins. Then it's banking the underbanked. You have some people in developing countries that do not have a bank account, or poor people in the US that do not have a bank account, and they like to have a stablecoin. I think that use case is very much overrated. I think it's very small. I spoke yesterday to Ivan. He's the waiter from the Philippines at the restaurant we attended, and I asked him how he does his remittance transfers back to the Philippines, and he does not use stablecoins. He uses an app which is similar to Revolut. So there's no need for stablecoins to bank the underbanked. And the third big use case for stablecoins is illicit transactions. And I think people who want to do those illicit transactions, they like to have dollars mainly. I mean, think of the James Bond movie. When the guy flew into the middle of Africa to recover all those bills. Those were not euro bills, were dollar bills. Yeah? And also the crypto assets are all denominated in dollars. So people want to trade in and out of Bitcoins. They don't want euros, they want dollars. Yeah? So the main user groups for stablecoins want dollars. And this is why it's really not an issue for the euro area. So opportunities and threats from stablecoins. I mean, stablecoins are basically a money market share that pays no interest. So the biggest stablecoin out there is Tether, has a market cap of 177 billion, earns interest of around 4% per year. That gives it 7 billion. So the main shareholder of Tether, he sits somewhere in the south of France, and he collects 7 billion per year. Yeah, so that's the use case for stablecoins, and with that money, you can influence a lot of lawmakers in the U.S. to prevent CBDCs. Yeah, so that is stablecoins, and there is now a discussion in the U.S. Senate Banking Committee to allow stablecoins to pay interest. They are not supposed to be called interest because interests are unlawful under Section 4 of the Genius Act. They're called rewards. Yeah, which is like Sukuk. Sukuk also doesn't pay interest, but so they're going to split the rewards in three. A third stays with the issuer, a third goes to the exchange, Ethereum, and a third goes to the holder. I just don't think this is very attractive. And I think this is also why stablecoins are just not growing anymore, because any sensible person that has money on deposit wants to earn an interest, and you're not going to earn anything on stablecoins. Now, what is the problem with stablecoins? They're not stable, as Megan just said. And the prime example is Circle, that traded at 87 cents on the dollar in 2023. So it's a sunshine product. Right now everything is fine, but they're not under any obligation to redeem at par. There's no mechanism to ensure that they will redeem at par. They have no access to lender of last resort, and they can trade anywhere. Yeah, so they're not really that stable, those stable coins. Now there is another problem of the stable coins related to Europe. Yeah, so Europe really is a sideshow for stable coins. We don't have any euro-denominated stable coins. Nobody in Europe needs stable coins, I would say. Yeah, however, there are multi-issuer stable coins, and Richard Portes, he put out a really nice paper on that, where he shows that when you have this multi-issuer stable coins, Europe could become the ATM of US holders of stablecoins. So imagine you have a multi-issuer stablecoin which has part of its reserves in euros and the other part in dollars. Yeah, and then they have a lot of outflows on the dollar side. Yeah, and they need to gain liquidity. They don't get that liquidity, but they have access to the European money market. So they could actually, redeem euros to satisfy the redemption requests. So that could lead to a situation where Europe really has zero advantage from stablecoins, but a potential cost associated to stablecoins, because we could become the ATM for US stablecoins, something that we should try to avoid. And I hope that the future vice president of the European Central Bank will, do something about that. Yeah. So here's a little overview of different forms of cash equivalents. And they show you, why I totally agree with Megan that tokenized deposits are the future. And there's something more on the right-hand side, which is even more attractive than tokenized deposits. Yeah. So cash obviously has no return, but also has no counterparty risks. Bank deposits have a bit of a return, but they have counterparty risk in exchange. Stable coins have no return and they have counterparty risk. Yeah. So that already shows you, what do you need that for? Yeah. It's really a very limited use case for stable coins. Now, tokenized deposits. Oh, sorry, there's a mistake on my slide. Tokenized deposits, on the other hand, they have liquidity, transferability, and they have return. Yeah, so the red one should actually be green. So tokenized deposits are, I think, a very good alternative to stablecoins. They have properties which stablecoins do not have. And the best thing out there really is tokenized money market funds. Yeah, which is something that some asset management companies will start to issue. So you will be able to invest in money market funds. They give you high liquidity, high transferability. They give you better return probably than a bank deposit, and zero counterparty risk, because you're going to be the ultimate holder of all those securities in there. So I think when I have this race that Megan described, the hare is CBDC, the rabbit is the stable coins, the rhino is the tokenized deposit, and the elephant is tokenized money market fund. And that's what we're going to bring to the market. So then finally, here's the answer to the question that Boris raised about the future of finance. I do think that we're moving into a different world with the new technological innovations that we have. We can call that Web 3.0. So we start with a world we're using the internet only to write. Currently, we're in a world we use internet to write and read. Everybody can put up a blog and then write something on Substack. Yeah, and the third world we're moving into is one where we'll be using the internet to write, read, and execute. Yeah, and all of that can be done with digital assets. And I think tokenized deposits are the way forward. And Maria Luis Albuquerque, she agrees on that. For stablecoins is programmable payments. That's something actually quite interesting, that you make payments conditional on meeting certain requirements. For example, one thing that is very common in Germany, it's very un-German, but it's very common, yeah, is fuel card would be to have a stable coin that actually only to the petrol station guard if if the fuel card is presented and a little camera shows that actually it's the number plate of the company car, yeah, so that has been refueled. So, and you can think of many other ways of programmable payments which combine certain conditions before a payment is released, and that can be done with stable coins. However, it can also be done with other forms of digital payment. So it's a good advantage, it's a nice innovation, but it's nothing really that is genuine to stablecoins. Yeah? And then apart from that, I think stablecoins are of limited use. It's not going to be a big thing. Multi-issuer stable, nobody releases them. Yeah, and this opens an opportunity to Europe. European financial institutions can bank on tokenized deposits and CBDCs, and then thereby basically forge the future of finance. Yeah. Thank you.
Thank you, Chris. Okay. So far, 2 votes for tokenized deposits around the table. David was neutral on that. Brunello.
Thank you very much. Yes, I also have a quick presentation to answer your question.
No, but make it short.
Yes, it will be short. And so, because the point here is trying to see stablecoins from a macro perspective, a geopolitical perspective, so top down rather than bottom up. If you continue looking at these things bottom up, you will continue be dragged down in the discussion about use cases and so on. And I think is kind of just a partial way of looking at things. So let's start from a very top level and build up the argument in a stack that will be hopefully clear as I go by. So spheres of influence. The world is polarized. These are the countries of the Belt and Road Initiative, BRICS, and countries in which you can use the Chinese CBDC. As you can see, it's pretty big. This is 50% of world GDP, 75% of world population, 155 countries out of 195 in the world. Is big. This is what we call the rest. So the rest of what? Is the rest of the West. What's the West? The West is this one. These are the blue countries in which AI technology of the latest nature in the US can be used freely, okay? So as you can see, these are 2 equivalent maps. This is effectively the same map, but starting from very different perspective. One is Belt and Road Initiative, BRICS, and CBDC. This one is the use of AI, which is only free in North America, Western Europe, Australia, New Zealand, Japan, South Korea. That's it. That's the West. All the rest is, in fact, Chinese. What about Europe? Well, Europe is not strategically autonomous. They are aiming for that. And the problem is very well described in this map, where we can show that the only pan-European credit card circuits are, in fact, American. So we need to change that 25 years after creating the euro. First point. Second, energy production. The largest oil producer in the world is the US. They have the largest oil reserves. As we know, this is Venezuela, Saudi Arabia, and so on, but they are the largest oil producers. Who's the largest electricity producer in the world? That's China. As you can see, they've been skyrocketing over the last few years. In fact, they produce 40% electricity more than the US and Europe combined. In fact, and mostly come from now renewable sources. In fact, according to this EMBA study, all the new demand for electricity last year was met by renewable sources. So solar, wind, hydro, nuclear, and so on. So effectively, what we are seeing, if we put all these things together, is that 2 models in a polarized world, the West and the rest, let's say US and China, one based on a petrostate, if you want. Shale oil and gas put the US on the top of the oil production in the world versus China that produces most electricity in the world. we can call it kind of an electrostate in China versus a petrostate in the US. And there's an open competition at global level on who's gonna eventually prevail. What do you do with all this electricity? Not a dangerous conspiracy communist, but Elon Musk said that electricity output is the single best proxy for industrial capacity. We know that. In fact, Chinese industrial production is larger than that of the US, Germany, and India combined. What do they do with this electricity? Yes, industrial capacity for sure, but also they power a massive high-speed railways and the entire ecosystem that goes around it. You see how fast it grew from 2008 to 2020. In 12 years, they went from nothing to this, okay? Sometimes I take a sailor from New York to Washington. It's not exactly that experience. They also produce electrical vehicles, much more than any other country in the world. You see, you can think that you and China are the same, but look better at the scale. So China is in the 12 million, EU is in the 2 million phase. So is just another level. How this relates to digital currencies? Well, the linking point, as I was saying before, is the Belt and Road Initiative. This was launched immediately by Xi Jinping as soon as he was elected. But the day after launching the Belt and Road Initiative, he also launched the CBDC project. He knew that eventually he would need to go there. And in 2015, he launched effectively the three fronts of the tech war: the Digital Silk Road, which is the digital equivalent of the Belt and Road Initiative, the Made in China 2025, and CIPS. Now, Catherine has spoken extensively about CIPS, so I don't need to say much more. Just want to say one thing. Belt and Road has moved from the first phase, building bridges, ports, railways, and so on, into exporting Chinese electrical production, in particular, solar panels, production, and the software that goes with it. Actually, hardware and software. The hardware is the inverter, AC/DC, and the software is the one that allows that to happen. This is effectively a Chinese monopoly that is everywhere. In fact, is also in the US. NERC, the North American Reliability Electrical Company, has actually found that most of their software is, in fact, made in China. So China is exporting lots of things, including electricity production. This is the CIPS. As I said before, has grown quite a bit, but is everywhere, but especially in the countries of the Belt and Road Initiative. So all this serves the purpose of de-dollarizing the global economy, okay? So dollar as a reserve currency has been declining over the last few years from over 66% to around 58% these days. How are the US reacting to all this? They are reacting through stablecoins. So this is not a Trump fan. Paul Ryan sits on the other side, if you want, of the Republican Party. It's not MAGA. And this was published actually on the day of Trump's second election, 5th of November 2024, on Project Syndicate, not necessarily an outlet favorable to Trump. So even those who are not exactly Trumpian believe that the stablecoins will be the response to Chinese de-dollarization of the global economy. How do they do that? Let's look at SWIFT versus Tether. Now, SWIFT is in the blue countries, and in the green countries, this is not where it's not present. And again, Catherine did a tremendous job in describing what it is, how we got there. But look where Tether is mostly diffused. Guess what? Is exactly in those countries where SWIFT is not. So if you combine the two, effectively, this is a project of re-dollarizing the global economy. So in an equilibrium, you could think of a race between US and China, more particularly US stablecoins and Chinese CBDC. Now let's go to the recent events. We all know that Iran asked to pay a toll for the Strait of Hormuz. How would you pay the toll? Only three ways: ECNY, Bitcoin, and Tether. So clearly now the geopolitical component of this digital currencies is becoming evident or self-evident. And why is this happening? Let me borrow some of the concept that Catherine discussed before. Here we need to re-anchor the dollar. let's look at the anchors of the dollar over the last few years. Of course, we knew it was gold during the Bretton Woods period. Then war in Vietnam, lots of redemptions, people want gold back. In 71, Nixon said, sorry guys, it's not gonna happen. So there was the depeg from the dollar to the gold. We entered these periods that ended up with the first oil shock, which effectively was a way of the oil producing countries to say, hey, we are giving you good oil and you're giving us, a very devalued dollar. So let's re-anchor this, okay? So they launched a double anchor, the fiscal anchor, dollar linked to the treasuries, and the petrodollar, effectively creating global demand for dollar to buy oil. What happened to these two anchors? Well, look at that. That's US debt over the last few years. It's increased exponentially under any administration. So, and the last hit, I would say, is the big, beautiful bill by Donald Trump that has effectively increased the US Treasury debt by 4 trillion over the next few years. So that anchor is almost, well, let's say undermined. But the petrodollar also has been undermined by the war in Iran because oil doesn't flow freely anymore. So what do they want to substitute these anchors with? My answer is going to be substituted by a new form of energy. And this new form of energy is data centers. Data centers compute all this industrial production that is used to produce AI and so forth. Most of them are in the US. And as you can see, they consume as much energy as large countries. You see here Italy, Australia, Spain, and so on. They are gigantic, like as big as 130 football pitches put together. Some of them are in the Middle East, in the countries that in fact hosted some of them, and that's the reason the retaliation of Iran was mostly against the data centers of US company in the Middle East, not the US bases, because that was a way of attacking the new anchor of the dollar. So, but what is compute? Let's ask the biggest of all, NVIDIA. What is compute? Compute is nothing but a very sophisticated version of energy. In this 5-layer cake, you see that NVIDIA technology and effectively hardware is nothing but a repeated sophistication of underlying energy. So eventually, this battle between the US stablecoin and Chinese CBDC becomes a battle between the new petrodollar, which is effectively a stablecoin compute, versus the electro yuan. What about Bitcoin? And this is to answer a question to some of you that have asked repeatedly during these days. What is it doing in all this? Well, are we sure it's a two-way race? No, it could be a three-way race. Why? Because Bitcoin uses much energy as a large country, say Poland, to be produced. For many years, we have considered this as being a negative externality of the production of Bitcoin. That's wrong. This, in fact, is the value of Bitcoin. The value of Bitcoin is the value of the energy used to produce it. It's the value of the integrity of the blockchain, the fact that it's immutable and trustworthy. So eventually, you're going to have a three-way race between petrodollar in the new form of USD stablecoin compute based on fossil fuels in the US, the electro yuan based on mostly renewable and the electrical grid that runs of it, and the Bitcoin that through its proof of work is one of the few that still does it, so lots of energy consumption still preserve value. And therefore, in the future, it's going to be a three-way race, in my view, between US stablecoins, Chinese CBDC, and the Bitcoin. And if that makes any sense, the answer to your question, Bori, is I think what Scott Besson said might be even an underestimation of where the stablecoins can actually be, much larger than we actually believe at the moment. Thank you.
Okay. Thank you, Brunello. Yeah. So we're going now to Chris. You've heard everything, and you decide where to start from.
Yeah, a lot of stuff said here so far. And I have to say, of course, whatever I say are my views, and I guarantee you my colleagues will tell you that too. These are his views. So on stable coins, I've always just looked at stable coins as it's just a payment instrument. There's nothing evil about it. There's nothing dangerous about it. It's a way in which you can conduct transactions and use it as a payment. Now, what's interesting, it's created in DeFi, and it was created in DeFi to serve as a medium of exchange. Even the Bitcoin bros who thought Bitcoin would be the currency is not used for payments. People buy Bitcoin using stable coins, but they don't use Bitcoin to buy other stuff. Now, it works amazingly well in the Bitcoin world. It has no regulation. There has no sovereign behind it other than they're pegging it to dollar and promising to give you $1 if you want it back. So it's amazing. Unstable, it immediately repegs because people believe it's going to be backed and redeemed. So try that with some other currencies that depeg and see how fast they return back to their peg, run by sovereigns. So this is just kind of a silly argument that it's unstable compared to other currencies in the world. Now, what stablecoins bring, and everybody gets caught up in the stablecoin, but what it brings are crypto rails into the payment system. It's a different way that some object can transfer across individuals without having to go through the banks, go through Visa, go through MasterCard. That, to me, is pure competition. There is now a new set of rails that you can bypass these monopoly-type networks to make payments. So for me, it's bringing competition in the payments world. Now, it may never have a big footprint in terms of being used, particularly in retail, but it's a competitive threat to everybody else to keep prices and costs down. That's all we care about as economists. I don't really care what the actual object is. Now, I will tell you that these things are used for cross-border payments, and they are scaring the banks. If you think banks don't think this is a threat, then why are they lobbying so hard to stop it? Why would you waste resources politically over and over lobbying if you didn't think this was actually a serious threat to your income, your resources, or whatever? You're just being dumb if you're doing that. So they view it as a serious competitive threat in the payments landscape. Now, whether you and I buy a stable coin and use it to pay is also irrelevant. You go through an intermediary to make a cross-border payment. You don't know how that thing is done when you go to a bank, when you go to Total Space. If you go to something like Wise, you don't know how it's done in the background as a business or a consumer or whatever. You just know that you give them the money and it came out the other end. That's where blockchains and stablecoins get used. It's the way that the intermediaries transfer money around the world, and they can do it very fast and very cheap, and you don't even know it, right? So that's my point. It doesn't require me to have a wallet with a lot of stuff. It just requires the intermediaries doing the payments to be able to move it on these rails. Now, what I also find fascinating, given the discussion we had yesterday about when we talk about private credit, this is an interesting case where some financial instrument in the shadow financial sector wants to come in and be regulated. Usually everything goes the other way. Something that's regulated is trying to get out of the regulated sector and get into the shadow. This is just the reverse. Stablecoin issuers circling, they want to come in. They're happy to be regulated. They're happy to be following the rules. That's the whole point of the Genius Act, was to say, here are the rules, come on in and abide by those rules, and you can operate. Now, do these things bring risk of illicit finance, tax evasion? Yes, of course, any currency does. If that's the case and you're really worried, stop printing currency. Ken Rogoff has been saying this forever, but no central bank will. So you're accepting some degree of illicit finance, tax evasion, money laundering, whatever, by not getting rid of your own currencies. So if it brings that, should we ban it? No, it's a benefit cost calculation, right? Yeah, there's going to be some potential cost to doing this stuff. Let me give you an example I've been using. AI, does it bring greater risk of fraud into the payments world? Absolutely it does. Everybody's worried about the potential fraud from AI. Is anybody calling for banning AI because of that? No, you're just going to have to figure out how to deal with it. So the critical thing for me is there a new payment innovation. Don't kill it before we see what it can do by over-regulating it. Now, are these things a threat to U.S. monetary sovereignty? No, they're going to expand it. I believe in the same view that Besson has on this, which is stablecoins are going to broaden. And it's going to be like a fixed exchange. Countries that adopt it, it's like a fixed exchange rate system. You are going to import US monetary policy. So it's broadening the reach of US monetary policy to countries that use more stable coins. Now, should we ban stable coins because countries with bad banking systems and unstable financial regimes and lots of financial repression, so I can continue to support that? It's not my problem. You got a bad banking system, that's your problem. It's not my job to protect you from any kind of outside threat. So it's a discipline on other countries to have better banking and financial systems. Now, one other thing is, I guess one of the key questions here is, does it affect US monetary policy? I would say no. I don't look at the money supply measures when I sit down at an FOMC meeting and say, should I raise or lower interest rates? I have no idea what these numbers are. We don't look at it. It doesn't matter, unless you're Switzerland and Germany, the ones who still do. How payments are made over what rails does not enter into monetary policy discussion. And let me give you from the academic literature. What's the main macro model that we use for all kinds of policy analysis? It's a standard new Keynesian model. Where's the payment instrument in that model? None. There's no payment instrument. There's no way that, nothing is said about how payments are getting made, but we set policy completely independent in all of our theoretical models without having a clue what's doing all the payments for transactions in those worlds. And then the last thing I just want to make, there's this myth that these things are going to disintermediate the banking system. This is nonsense. They can't. It's a closed system. When I go to the grocery store and I buy an apple, money goes out of my bank account into the grocery store. So my bank, yes, my bank lost deposits, but the grocery store's bank received deposits. The same thing is true with a stable coin. If I go buy a stable coin, I give it a claim on my bank account. They give me a stable coin. What do they do with the claim on my bank account? It only has value if you do what? Bring it back into the banking system. It's not a hand-to-hand bearer instrument that you can go use like currency. It's a claim on my checking account or my bank account. So this stuff has to come back to have any value. So this is just a myth that it's going to demystify or disintermediate the banks. It just can't. It's a closed system. The only way you can have these things leave is through convert it into real currency. You go to the bank, say, I want paper currency. That will disintermediate the banks. You put it in reserves of the central bank. That will disintermediate the banks. Or you put it, for us, you put it in the Treasury's checking account, the TGA. That goes out of the banking system. That's the only way that this stuff can leave. Now, if the banks want to shrink their balance sheets, they're more than welcome to, or that, but it's nothing to do with stable coins. This is just a big myth that this is going to do this. So I'll stop ranting.
Great. Thanks a lot. Interesting. I will open immediately now for the questions. I have my own, but I'm sure there are many there. Okay, so let's start here, and then we're going to go to the right. I have 4 for now. Yeah, Marcel.
Thanks so much. This fascinating panel, and we can't comment on everything. So let me just comment on the notion that the role of the dollar is in this danger of being really hurt. I mean, and I was a little bit part of the politics of BRICS, just for a little bit of time. And there's no way any Chinese instrument is going to substitute the dollar if the renminbi is not fully convertible, period. So that's fantasy. I mean, and if you look at the decline of reserves in dollars, that has been more than compensated by a big increase in demand from the private sector. So the US is this big balance sheet absorber of the world with this big demand for many different types of US assets, which, by the way, this administration has been complaining and blaming that aspect of it for the high value of the dollar and all the way they look that is upside down. So I'm not saying that the dollar is like immune to policy and that I do not get concerned about the weaponization of the dollar and all that. That's fair. But the idea that there is an actual alternative to the dollar, even in our foreseeable future, it's fantasy, I think. But anyway, so that's just a comment, and I'd like to have a.
Thank you, Era.
Thanks, so very interesting. So I'm going to talk about a slightly different use case, which is on the fiscal side of things. I mean, stablecoins are seen as sort of creating a relatively price-insensitive demand for short-term treasury bills. And that from a demand management perspective, that makes sense. I mean, you could say, okay, this is useful, but then it also creates rollover risks. I mean, there's, and it changes the way the yield curve looks and sort of shortens the maturity of US debt. And so debt levels are high, we're shortening the maturity. Stable coins, are they playing a role or not? Or would they play a role or not? So I would like to pose that question to the panel. Thanks.
Thank you, Ricardo. And then, then it's going to be you.
I like the panel to comment on two things. A Chicago economist, Luigi Zingales, interviewed the father of modern finance, Eugene Fama, a few months ago. And the question was, what is going to happen to Bitcoin within the next 10 years? And Fama replied that he thought that the probability of Bitcoin going to zero is close to 100%. This is the first thing I would like you to comment. And the second is some of you are familiar with the 1933 Chicago proposal, Henry Simons and others, of the narrow banking that finally didn't materialize. And my question to the panel, isn't it the case that belatedly stable coins are the narrow banking proposal of Henry Simon?
Okay. Thank you.
Hi, everybody. I have a question about coexistence of CBDCs and the banks. So before I ask, just a disclaimer, I'm just an intern and this is my first conference. So if it's a stupid question, just ignore it.
No,
okay?
that's encouraged.
So yeah, anyway, so I think, let's say if we introduce CBDCs, I think it's just going to be a matter of time before people start asking the question, how come is it that banks get paid to keep their money at the central bank and people don't, right? So then it will be up to the central bank to justify why is it that when a bank has a deposit at the central bank, they get paid the deposit rate, but private citizens don't. So my first question is how you would justify this. Now, my second question is, let's say some populist party gets into power and they decide that private citizens have to get paid a deposit rate equal to the same rate that the banks get paid when they keep their deposits at the central bank. In this world, why would anyone still have a deposit with a retail bank and not at the central bank? Because the central bank deposit, the CBDC, is 100% safe and they still get a return on it. So how do you see then the existence of banks in this context of CBDCs? Thank you.
Thank you. And one more here, then we're going to have a second round, or maybe we take this first, and then we have already two for the second round. No, but let's wait now. So, David, who wants to pick?
Sure, I'd be.
What?
Well, I'll answer let me try the dumb question, which isn't dumb at all. No. It's a very good question. The last question you asked was, I think, you asked how retail banks would compete against an interest-bearing CBDC. Very easily. They'll raise the deposit rates to retain their deposit funding. It'll cut into their profit margins, of course, but I think that they'll do whatever they can to retain the lowest cost funding that they have available. And in fact, people have advocated or suggested that might very well happen. Just very quickly for Ricardo, Bitcoin, Fama, who listens to what Fama has to say anymore? Bitcoin going to zero, I mean, it's a perfectly legitimate bubble asset. It's not going anywhere. Chicago plan, stable coins being kind of the manifestation of the Chicago plan. Not quite, almost. A full manifestation of that would have seen, grant the stable coins Fed master accounts, 100% reserves, and then prohibit the commercial banks from issuing deposit liabilities. That's not going to happen. In fact, it's going to be the opposite way, as Megan and others have pointed out, where you're going to see tokenized deposits possibly crowd out the stable coins.
Thank you. Megan.
Yeah, I'll just pick a few of these. On the dollar as a reserve currency, I agree there isn't really an alternative and probably won't be in my lifetime, I don't think. This question about banks and a central bank digital currency coexisting, I think, is a great one. I agree with David. Banks will just increase their deposit rates. But of course, banks don't just have a deposit base. They also lend. That's the other half of kind of their money-making model, to simplify it. And I can say as a central banker, I have no idea how to do a know your customer analysis or an anti-money laundering analysis. I don't know how to evaluate loans in the same way that people who do that for their main jobs do. So banks will still have a function, I think, beyond just having a deposit base. I think Bitcoin is a bit like tulips. So I think it's a very effective security, but not as effective as an actual currency. So I think it will continue to exist as a security that you can dip in and out of depending on your risk tolerance. So I think it will stick around. I just don't think of it as a currency. It doesn't have a lot of moneyness to me. And on the question about stablecoins financing U.S. Treasuries, I guess you're asking, does that increase or decrease risk? I think you're right. That these stablecoins are backed by short-term government debt, so T-bills, and that does reduce the average maturity for Treasuries, and so there is a rollover risk. When will that become a problem? I can't tell you. The U.S. Treasury market is the biggest, most liquid market in the world, so I think it might take a while. But I do think that does increase the risk.
Thanks. Chris?
Yeah, I'd just like to comment on the last question, and then could I also comment on Chris Waller?
Yeah, you could comment also on Chris Waller, but there was Marcelo also telling you. No, to Brunello. Sorry.
That's right.
It's for Brunello.
So on the last question, you had two questions. No, your first question was, how do you justify that CBDCs are not interest-bearing? And your second question is, if you give non-banks access to the central bank deposit facility, why would anyone hold deposits at a commercial bank? No. And I think your second question is the answer to the first question. No. So it's precisely because if you give non-banks access to the deposit window, nobody would hold any money at a commercial bank. This is precisely why you cannot allow CBDCs to be interest-bearing. Yeah, they cannot compete with deposits. And CBDCs are dangerous because they introduce a lot of volatility on the liability side of commercial banks. And this is why they're going to be capped at 3,000 euros in Europe. And if I could just comment briefly on Chris Waller. So, Chris, you said that there can be the stablecoins can be a competitive threat to banks, and they can be discipline on other countries. I can't think of any asset class with a 300 billion market cap that can fulfill those functions. They're just too small, to be a threat to anyone. And then you said that, stablecoin issuers want to be regulated. Well, Tether, they hold 10% of their assets in gold and in Bitcoins. They precisely want to be unregulated. This is why they're offshore. This is why they're in El Salvador. And then you say that it's silly to argue that stablecoins are unstable relative to other currencies. Well, stablecoins are like a money market funds. And as we know, money market funds can break the buck. Yeah. So
they don't promise a return.
Yeah, but a money market fund is less stable than a bank deposits. No, I was thinking that is the case.
Okay, we have a two-hander by David here.
Yeah. So
Brunello, wait a little bit. Just we have a two-hander on Chris.
I'm sorry, Brunello, but I just have to push back on Chris's comments. The alleged instability of money market funds. Be careful, Chris. I mean, the primary reserve suffered problems in 2008, but that was a prime institutional fund. And yes, we can learn lessons from that. But the government money funds were quite resilient at the time. And the Genius and MiCA compliant stable coins are going to be more like government money funds that show that resilience. So I don't accept that claim that you make about the inherent instability of at least these MiCA and Genius Act compliant funds. Tether is another animal, but I did discuss that at length. In regard to what you say about the payment of interest on CBDC, I know of no economic model that suggests the claim that you just made, that it's necessary that CBDC pay zero interest. And I do not understand the Genius Act restriction, the Regulation Q type restriction it imposes on stable coins. I mean, this is a restriction that we imposed on commercial banks back in the day that we removed, and I argue that it had benefits. So anyways, I thought I would just push back a little bit there, just to add a little bit of spice.
You want to respond, Chris? Quickly? Shortly? No. Brunello.
Yes, thank you. So I'd like to take some of the questions. First of all, Marcello. So if my slide, the first slide, proves anything, is that the world is polarizing, okay? So you need to think in a world in which China has its own web, it's not worldwide anymore. China will have its own satellites, everybody will have his own internet, and it will be not necessarily interoperable. This is not good news for us, but that's the world we are headed, okay? So China has tried to internationalize the renminbi for quite some time without any success. Why? Because in order to have a good global reserve currency, you need to run a current account deficit, so the currency goes out, and an open capital account so that you can, transform it anytime on request. China doesn't want to do either, right? It doesn't want to run a current account deficit. It wants to close capital account, otherwise there will be capital flies, right? So that model didn't work. That's why they resorted to the electrostate. So they have a completely new model based on digital currencies in which this is going to be a closed system for them and their countries, that they don't plan to de-dollarize the West, so to speak. That's for the US, okay? They run on all other countries, Africa, Latin America, Middle East, if they can, and so on and so forth. So let's not think about a competition between one versus the other. They will be at the same time, as I said before in my slide, maybe a three-way race. In fact, that allows me to answer the question by Ricardo on the Bitcoin. It's not going to go to zero. Let me tell you, it's not going to go to zero. It had many chances to go to zero, and it keeps on going up. In fact, is deflationary. You need to think as Bitcoin as tokenized energy. Tokenized energy can go hand to hand and is not inflatable, okay? Actually, it's deflationary. Since it's capped at 21 million, it will only increase over time, okay? So it's not going to go to zero anytime soon. On the fiscal, yes, you're right. Clearly, Scott Bessent saw an opportunity of financing the big, beautiful bill with the new buyer of treasuries, of course, increasing the rollover risk, as you suggest. But that's a price well worth paying, considering that the volatility that we saw in treasury market when the big, beautiful bill was, in fact, approved. On the coexistence between CBDCs and banks, guys, sorry. Let's consider the words central bank digital currency. Central bank, okay? Which is the bank or the banks. Secondary objective of all central banks is financial stability. We are going to have the champion of financial stability as of tomorrow, okay? Here. Okay, do you think that they want to create financial instability by disintermediating banks? Of course not. So it's not going to be one versus the other. This is a one-tier system that nobody is talking about. It's going to be a two-tier system. The liability is of the central bank, but the wallets, the digital wallets, will be issued by commercial banks. And so the question for commercial banks is how to make money in the new world. Can they continue to make money by organizing the payment system? No, because Bitcoin has proved that to move money, you don't need to spend that much money, okay? So abandon the old revenue line on payments, in particular cross-border, focus on something else in digital finance. I mean, Chris said it very well. Web 3.0 is read, write, own, if I may say, rather than execute, read, write, own. And so the banks will be at the core of that. In doing what? Issuing digital wallets, having custody, exploiting on-chain lending opportunities. and issuing their own stablecoins, alone or in consortium as with Kivali. So there will be plenty of new revenue lines if they know how to execute it, which is the reason why, as Chris said, they've been campaigning so hard against Bitcoin, against stablecoins, because they see it as a threat. But they see it as a threat because they think with their eyes on the reverse mirror, right? Instead of looking ahead, the future of the profits that they can make if they embrace the digital revolution, something they haven't done so far.
Thanks, Chris.
Yeah, I'll just touch on a few things. So, Ricardo, I think what's fascinating about what we're seeing now is for the first time in centuries that you're able to split the payment system off from the banking system. That's it. I mean, that is a new world that we haven't, and that's kind of what the narrow banking, that's the basic genesis of the idea. Split the payment system away from the credit risk aspect of banking. But we've never seen it. So we're now in a situation where we have firms that can do all this type of payments with stable coins, and it's completely outside of the banking system. And like I said, there's nothing evil about it. It's just you're not going through the banking system. So I think I don't like calling them narrow banks. They're just non-bank payment firms that do this. On the fiscal stuff, it's going to hinge on whether they want to meet the demand by issuing more treasuries, or they just let the price get bid up and the yield goes way down. It's up to whatever treasury wants to do on that. I want to touch on this Bitcoin thing. Bitcoin is not a currency. The crypto people don't even use it as a currency. It's electronic gold. It's the best description I can think. It's a commodity. They buy it, they hold it, they hope it goes up in value. Maybe it doesn't. I consider Bitcoin kind of like baseball cards in the US. They don't really generate anything, but you buy them and hope they might go up in value. A couple last things. CBDCs. Good God. I gave a speech on this 5 years ago when this was the rage in central banks, which was to come up to to create a central bank digital currency. And I asked one simple question. What is the major failure in the global or US payment system that requires a CBDC and only a CBDC to fix? You can't answer that question with a CBDC. There is no good answer to this. And that's why since I gave that speech in August of 2021, almost every major central bank in the world has just stopped. They just can't find a reason for this, the solution in search of a problem. So the idea that somehow it's the US Senate and the crypto guys, no, we stopped. We had no interest in working on this thing because it wasn't going to fix anything. So this thing, only the European, only ECB and the Chinese. And the Chinese, two banks.
Well,
And nobody in China uses the thing anyway. They like WhatsApp and Alipay. They don't even use this stupid thing. They couldn't even get it through the Olympics to get people to use it. Jeez. And then last thing, I'm really still not clear what the big value of tokenized deposit is. Tokenized deposit means you can go trade stuff on a blockchain. What's the big advantage on the blockchain? 24/7 trading. You can do that now on FedNow. You can do that on TIPS. You can do that on RTP, which is the private sector real time. They run 24/7. So you can do payments and they're very cheap. Programmability, smart contracts, that's again, this is one thing that was said. They're not unique to stablecoins. Smart contracts can be run on any payment system. So I personally don't see the big advantage of a tokenized deposit world when you can already do 24/7 payments very cheaply, as Marcelo was talking about PIX in Brazil. I mean, you can already do it. That's coming, my friend. Once you start linking these into real-time payments, that's down the road. I'm not saying when or how, but that will eventually start happening. So I'm not as convinced that the tokenized deposits are going to be the thing that, is the miracle payment solution for all things. Since again, it's already available. The biggest problem we have with these real-time payments, we don't connect to every single bank. And that's kind of where the potential problem comes in. So, but that'll get fixed over time. Eventually they will. And then once we do any kind of bank or inter payment systems, which have more about governance, not technology, I just don't see what you're getting with tokenized deposits.
Very good. Now we have an interesting discussion. So, Megan, No,
Yeah.
well, let me just say that I know exactly where Chris thinks that the baseball cards price will go soon. So,
Yeah.
Go on, Megan.
Yeah, just to push back on this tokenized deposits thing. That's why I started my first intervention by saying, what's the point of this? And the point isn't just payments. It's about smart contracts. And so, you can't currently have tokenized securities that automatically transact off the back of a delivery of something the way that you can with tokenized deposits. So we don't have the system for that. You do need a tokenized asset with some kind of ability to embed it with a contract. So you can't do that with the Fed now system. Just doesn't exist.
No, but we can. We've already experimented with how to. All a smart contract is, it is a different messaging system. That's all it is. And it can be executed on our payment systems just like anybody else. We haven't done it yet because there's really no demand for it at this point in time. But technologically, it's not a problem. It's just a different messaging system. It has to have certain things executed at a point in time. That's it. It's not that complicated.
But it's messaging and execution. I think that's the crucial bit.
And the tokenized deposits are also going to be issued by, commercial banks and that fall under a different regulatory umbrella than stable coins.
Yeah.
And I think a lot of multinational firms are likely to end up preferring kind of, they have relationships with banks already. Banks aren't just about payments. These big multinationals want to do business with these banks for a variety of reasons. And Chris, I'm not saying stable coins will disappear, but I don't see them eating. I see a role for coexistence here.
Very good. And Chris, you know that I would side with the David on that one. We had a discussion in Jackson Hole with Mickey and Pierre, and you know what? I would think the same. I would also go for the tokenized deposits team. Chris?
Yeah, no, I said that in my opening remarks. I don't know if stablecoins will ever have a big footprint, but we know this in economics that all you need is competition on the fringe to drive pricing. That's it. It doesn't have to be a big thing. And one other thing on the market cap, a lot of these stablecoin transactions, you mint it and burn it on the same transaction. It's not sitting in somebody's wallet. You mint it to run it over the rails. It comes off on a platform, it gets burned, and that's it. That helps speed, transmission, cost, everything. But it doesn't say anything with the market cap. It could be zero. It's just one-time payment object that goes in. That's it.
Chris? Yeah. Chris first, and then
sure. Three brief comments on the stablecoins. I really don't think this thing is going to take off. I think it's a strategic mistake by the U.S. administration to put all the emphasis on stablecoins instead of looking at the other forms of digital finance. I think it's snake oil. If you want to feed your citizens snake oil, go ahead, be our guest. Yeah, it's not going to lead you anywhere, I think. And I think you made a very strong comment, Chris. You said that digital finance will split the payment system from banks that are prone to credit risk. I think that's a very deep comment. And it raises the question, if that's really the case, if banks are no longer in the center of the payment system, if you split banking from banks, do you really need to protect banks in the same way you used to in the past? Yeah. So that, I think, raises a lot of questions for supervision and regulation. Do you really need the lender of last resort in the same amount that you used to use them in the past? And the last point I wanted to make is this question is, what is the market failure that CBDCs are trying to address? Yeah. I mean, we discussed that here last year. Just a brief example. There is this German lady who works for an NGO called Hate Speech. Yeah. All she does is try to enforce European regulation. Yeah, she gets funding from NGOs for that. Yeah, she's been sanctioned by the U.S. government to the point that she can no longer buy a flight. Yeah, or rent a car because it's all done on Visa and MasterCard. Yeah, so the problem that we're trying to address here is an overreach of U.S. legislation or whatever executive power, yeah, that is weaponizing the US payment system to the detriment of European citizens. And we need to establish our own independent payment system and payment infrastructure to be independent of Visa and MasterCard and independent of the threat of US sanctions. The first best solution would be private solutions such as PayDirect. It failed. Yeah. The second best solution is a CBDC.
And getting rid of NATO apparently is the next thing, right?
Well, that's what you're doing, no?
It's getting more and more interesting. Wait a little bit, Marcelo. This is the panel you want to have. Brunello, yeah.
Let me throw another. Yeah, let me throw in another thing. what's the biggest thing we have in front of us these days? AI, right? Okay, AI these days is AI agents. AI agents do what? They do virtually everything, okay? There's one thing they cannot do, buy stuff. As of now, as of tomorrow, actually as of yesterday to be honest, but as of tomorrow, they will. How they are gonna buy stuff? Well, there's a protocol that links AI agents with the payment system, X402, for example, by Coinbase, there are many others. And what is the payment asset that they end up with? There are effectively only two. CBDCs, so a central bank settlement asset, obviously, or way more likely, stable coins, in fact. So all AI agents in the world will use stable coins for their transaction. They are not going to be given a credit card number. They are not going to be given a tokenized deposit. They may, but most likely they will be stable coins. So in the future, stable coins will have their obvious use by AI agents that will be everywhere, doing most of our jobs, in fact.
Thanks. Marcelo now. And then, no, you first, and then Marcelo. You have a microphone. So.
Exactly, I have the mic already. I have to brief personal confession up front, right? I have to say that I've enjoyed this entire conference, even though this is a conference with probably the highest opportunity cost that I've ever been to. Just have to look outside of the window. But even by the high standards of this conference, this panel has been totally fascinating, really, and it will take me a while to digest all the divergent views and thought-provoking views. I actually had a question for Chris Kopf, but partially you have answered it now. You portrayed the CBDCs as the only rational way forward. Do you have any other argument apart from the one that you just put forward, which I don't believe you mean seriously, because this is not really a systemic argument in favor of central bank digital currency, and certainly not if you think as an economist in cost-benefit terms, right? I mean, to argue this project, that has cost so much and still will cost so much. I'm talking about the digital euro, and I have to say, I come from an institution that is a very strong proponent of the digital euro. So I'm certainly not talking on behalf of my institution here, but do you have any other argument? And also, given this entire ecosystem that we have just heard about and the large number of competitors that central bank digital currency will have to face, how will it be in the position to keep up with that competition? And does it necessarily have to be provided by the public sector, since there are so many private sector alternatives, right? And to come back to what Christopher Waller said, all the Western central banks have pulled back, right, or have backpedaled actually on their digital currency projects, and those countries which do already have it, the level of acceptance is rather low. So how would you convince someone like me, who has really tried for years to understand the reasoning for a digital euro, that this is the rational way forward and something that we really need and is worth the cost that we are paying for it? Thank you.
Thank you. Let me just correct you. There are 21 Western central banks that have decided to go with the CBDC, so it's not only one. It's Vedran first, then Marcelo. We don't hear you.
Okay, I'm on. So the topic is stable coins and monetary policy, and we kind of drifted away from stable coins, and we never even got to monetary policy. So I would try to steer the discussion a little bit back to the topic. There was a lot of discussion about positive interest rates, and Chris Kopf said that the stablecoin issuers are a little bit like glorified money market funds that pay no interest. Well, actually, it's more. To me, we have institution like that, and it's called the central bank. Central bank does not pay interest on at least a part of their liabilities. So, and coming from a central bank, I still remember that when we had to endure the period of negative interest rates. And so I'm wondering what happens if we go back to negative, to a prolonged period of negative interest rates. What happens with the stablecoin issuers? I mean, we can work with negative capital. I mean, Fed has the huge deferred asset account. I'm not sure what would happen with the stablecoin issuer if it would put in the assets, the item deferred assets, $100 billion. I don't think it would survive very long. I mean, it's not because of negative rates, of course, I understand that, but and even in case someone decides that it's not wise to operate with negative capital, we have examples of central banks that are being recapitalized with public money. For example, Riksbank received quite substantial injection of capital from the treasury. So, I mean, we are there is an inherent risk from negative rates. So I wonder what you think if rates go into the negative territory, what happens with the stablecoin issuers, whether it will annihilate them completely or they disappear or they can survive this natural disaster for them. Thank you.
Thank you. Marcel?
Chris, you went back to the debate you had last year. Always when someone say, I don't know why you'd have CBDC, you talk about payment system. You do not need a CBDC for that. You do not. So, and I gave, it was exactly, look at PIX. Why is the US government mad at PIX? Because PIX insulate the Brazilian payment system from MasterCard and Visa. So you need a payment system that is more efficient, fully electronic, and integrate the euro area. The CBDC, I'm not particularly against, but it's not the currency part that is really that you are claiming. You like to have that payment system. And it seems to me that the digital euro is a way to get the payment system in some sense, from the back door. And that's why the window, you cap at 3,000 for people to claim the liability, go directly to the central bank, exactly because you're trying to minimize risks of financial stability and all that. Actually, I would claim they should make that window €1 or something like that, very small. But you have the whole infrastructure put together, so you have a payment system that does not depend on the large American credit card companies. Again, it's not the currency aspect. I agree with it. I don't see the value of the currency aspect, but I do see the value of a better payment system.
Yeah, it's in the means of payment. Okay, let me stop here and go back to the panel. Who wants to? Chris, do you want to start first now, and we go from you here? Chris, you want to start first now?
No.
No.
I don't really I think I've said everything I need to say. I don't really have anything else to say.
Okay. Brunel, on any of these issues?
Yeah, very quickly on negative rates. And again, I think Megan said it very clearly, you can't say digital euro without saying strategic autonomy at the same time. So the answer to the question why is purely geopolitical. Full stop. Let's not pretend it's a settlement. No. The way you gain strategic autonomy is by printing your own money. Because if you go in the nitty-gritty of the transactions on chain, Chris said very well, you mint, you burn. The on-chain transaction can be done in Europe, okay? The part that is on-chain with USD stablecoins. It starts at euro in Germany, ends in Europe in France, but the on-chain transaction is in US stablecoins. You cannot possibly want that if you are if you want to have strategic autonomy. Full stop. That's the reason. There's nothing else. That's why geopolitics. That's why I brought this new viewpoint, if I may, on negative rates. CBDCs, in fact, can enable negative rates, actually can enable severely negative rates. The only reason why we didn't go more negative with rates in Europe is because there is still cash. So you can withdraw cash from your deposit where you're paying the deposit rate, the negative one, right? And store it in a vault. And so that constraint in how much you can actually lower the interest rate into negative territory. But the less cash is used, the more negative you can go. And so actually CBDC can enable severely negative interest rates, which could be a solution to the next crisis if they ever emerge. What happens to stablecoin? I don't care. They will need to figure that out. Hopefully they made enough money to withstand those periods. That's it.
And stable coins are going to make sure they don't do that.
Well, let me add another aspect to that you just commented. So imagine the stable coins really grow, okay, and doesn't that strengthen the zero lower bound on monetary policy, because they are redeemable at par, they have to be covered by the high liquid assets, and they don't carry interest rates. So more they grow, more of the zero lower bound goes up. So higher the probability you go to the negative interest rates, which then I mean the dynamics is interesting, I think, if you think about it.
Yeah, I mean, so, you take Brunello's argument with currency. All right, I can take all my money and put it in currency, and then I got to put it somewhere physically. And it's got to be safe, and it's got to be secure, and I got to worry about somebody breaking into my house and stealing it. That's the beauty of stablecoins. I mean, they're pretty much unseizable unless somebody really hacks into your account somehow or gets your identity key. And you can do huge quantities with zero storage cost. So that's what I'm saying, that stablecoins are going to kill this idea of central banks imposing negative interest rates unless you ban stablecoins and somehow lock off people from getting on the internet.
Chris?
Yeah, first I'd like to thank the National Bank of Croatia and Boris for inviting me again to this conference. Just to say how this came about, yeah. When I started my career, a lot of people were looking at Eastern Europe, and at the time the region had massive current account deficits and it was overheating, and I was very happy not to look at Eastern Europe at all. Yeah, and the first time I ever looked at it was after 2008, when at the time I was working in London, and my colleagues told me, look, somebody's going to have to look at region, and that's you, yeah. And then I remembered that Boris was already holding this conference in Dubrovnik. I'd never been there, but it was a very famous conference already at the time. So then we met at the IMF annual meetings, and I said, Boris, could you invite me to the conference in Dubrovnik? And he said, yeah, of course. Then he didn't invite me. And the next year we met again at Proof in Chinatown, and I said, Boris, I thought you were going to invite me. And he said, oh, Christian, I'm really sorry. Could you give me your card again with your details? And then he didn't invite me. And then a third year, I sent him a Christmas card, and I put my business card in there. I said, Boris, Merry Christmas. See you in Dubrovnik next year. Since then, I've been invited here. And when I heard the first question here, I thought you were going to say this is a great conference apart from the last panels. I was really happy that you did not say that. So I hope I do get invited again. Yeah. Anyway, on the questions, 3 brief comments. The first one, I wanted to come back to ERA on the issue of the fiscal use case for stablecoin. I mean, in the October 2025 annual meeting, there was a lot of discussion about what you mentioned, and at the time people said that the market for stablecoins would grow to 2 to 3 trillion, and then there would be an enormous demand for US T-bills, and the US government would be able to fund itself and actually also monetize its debt with the help of stablecoins. Turns out that the demand for stablecoins right now is capped at 300 billion, yeah, and it turns out that there's not that many people who are willing to forego interest payment at all, all of their interest payments in order to get into stablecoins. So I think this is a bit of a dead animal, the stablecoins. And then on the issue of the zero lower bound and stablecoins, I have a slightly different opinion from Chris Waller on that. Stablecoins that are issued under MICR or Genius Act are required to be invested in T-bills, so or money market instruments. So imagine we move to a world where the central bank goes back to a negative interest rate, yeah, and you force those stablecoins to redeem at par and simultaneously invest in instruments which have a negative interest rate. Now, that would not kill the ability of the central bank to impose negative interest rates, but it would kill the instrument of stablecoins. Yeah, so stablecoins would die, yeah, in that world. And this is why I don't think that stablecoins will constrain the ability of the central bank to impose negative interest rates. And finally, on the issue of what's the use case for stablecoins, I totally agree with what Marcelo has said. CBDCs are European CBDCs are a European payment system through the back door, yeah? And of course, it would be preferable if the private sector were to do that. Yeah. Now we know it's a duopoly run by foreign companies. There are high barriers to entry. They want to preserve fees. And if you look at the Brazilian example, it took the Central Bank of Brazil to establish PIC, for transaction costs to decline and everybody to have access to a payment system. So I think it's the second best solution, yeah, to get a proper European payment system. And this is what CBDCs can achieve. Yeah.
Okay, so the rabbit would die.
Yeah, I have to say I didn't have a discussion about negative interest rates on my bingo card today. Inflation's going up in the UK. So I think if we do end up in a world where we're contemplating negative interest rates, we might have bigger problems than whether stablecoin or tokenized deposits will take off more. But I do agree that, stable coins will be toast in a world with negative interest rates. I just wanted to add to something that David mentioned about multinationals probably preferring tokenized deposits rather than stable coins. I think it's also because, of course, tokenized deposits have access to central bank backing, whereas stable coins don't at all at the moment. There's talk of maybe setting up some sort of central bank programs with punitive pricing if need be in the name of financial stability, but they don't exist. We know how to backstop banks. We don't know how to backstop stablecoins, nor is that the job of central banks. So I think that makes them more attractive as well. And then just one last thing, Chris, you just happened to mention, what if your account gets hacked? And I guess I thought I'd just mention all these things can get hacked. And so if the point is to speed up transactions and have contracts happen automatically off the back of atomic settlements, that sounds great, except for in a world where we might have all this stuff hacked. And so I do think that all these institutions, financial institutions, will end up having to pay more and more and more for cybersecurity to stay ahead of the AI. And that's an unfortunate cost, but will be table stakes for everyone.
Which might be a good last question for the panel. What if we have Mythos 5.0 and Google comes with this type of high hacking power, AI powered devices, and at some point, there is a proliferation. It gets into the wrong hands, and deposits get blocked.
The answer is simple.
In some banks.
You need redundancy.
So we then have at the Dubrovnik conference a panel on the going back to cash bills of exchange, because we will say, bring your money to us, we are offline to the vaults, to the safes, and then Catherine is back into the game. There we go. Sorry, David, you go.
You want me to speak on that? That's outside my pay grade.
No. You just say whatever you want.
Oh, yeah, okay, sure. That's great. I thought I'd comment very briefly on the negative interest. I wanted to say something because I'm so surprised. I actually agree with something that Chris just said.
Chris Waller?
No, Chris Kopf. Against Chris Waller. I do think that negative interest rates would be feasible exactly for the reasons you said in that type of environment. I mean, if to the extent that stable coins would be required to load up on short-term T-bills, and to the extent those rates went negative, what would stable coins do? I differ, saying that that's the end of stable coins. They'd simply charge fees for this service to recoup the revenues they need. The other related issue is what would happen in an inflationary environment where stable coins are presently not permitted to pay interest. This is what happened to commercial banks in the great inflation of the 1970s with Regulation Q. I'll tell you what's going to happen. You're going to see a major stablecoin lobby, and they're going to change the law and permit stablecoins to pay interest in an inflationary environment. And believe me, we're not far from an inflationary environment. I think that I wanted to offer some way of reconciliation here, I think, because we got on the one hand, Chris Waller saying, what the hell, CBDCs, what are they good for? We got Chris Kopf saying, stable coins are snake oil. I mean, my own view is I've written a lot in the past on all these things, and I've adopted a view. I'm rather agnostic on the whole thing. I think at the end of the day, what really matters is that these systems, whatever we design, are well designed. It could be a CBDC, it could be a stable coin. I mean, as long as you have the proper rules, regulations, backstops in place, I think that they could, all of these designs could work tolerably well. That indeed, I think it's a good idea that different jurisdictions experiment with different versions. This is just let 1,000 flowers bloom, and let's see which system works best.
I think this is a very good ending of the panel. And I guess people want to go to the beach, so I will conclude the panel. Thank you very much.
I want to say one thing.
Yeah, please.
I want to say thank you to you for hosting us here in this beautiful environment. And I had the pleasure of hosting Boris in Miami. Ricardo and I had him serve on a panel that we had in Miami last fall. I know that the city of Miami will never be the same. And I know you'll be soon spending a lot more time in Frankfurt, and I'm not so sure if Frankfurt knows what to expect. But we'll, so thank you to you, Boris, and everybody involved in organizing this amazing conference. Thank you.
Thank you. Paul?
You know, every year I usually get up here at the end of the conference and say, thank you for coming. Send me your ideas for next year. Goodbye. But this year is a little bit different because today marks, as we all know, the conclusion of Boris's tenure as the governor of the Croatian National Bank. And we have to mark the occasion appropriately. I'll only do so for a few minutes because we know Boris is a dedicated swimmer, eager to get to the beach. And we also know, as we saw on that beautiful slide, that next week he's going to be rafting on the Rhine River. So we wish him well with his new responsibilities in Frankfurt as he becomes responsible for the well-being of 358 million residents of the Euro area, up a bit from his previous activities, responsible for a bit less than 4 million Croatians. So it's a order of magnitude of approximately 100 times greater responsibility, but we know that he'll do it well. Now, those of us who are real Dubrovnik veterans know that the Dubrovnik Economic Conference has trained him well for those responsibilities. You know, Boris was just out of grade school when DEC got started. And according to Tomislav's records, his first appearance at a Dubrovnik Economic Conference, looking very boyish and eager, was the third Dubrovnik Economic Conference in 1997. So it is with great pride and fondness that I look back on the years that followed that. You know, I've been dropping into Croatia once a year and watch Boris develop an understanding of the world economy, always grasping the right issues in an insightful way and intuitively grasping the best of economic research. Soon Boris became the vice governor and then the governor of the central bank, providing the bank and indeed the country with the leadership to bring a former transition economy. Remember, this started as the Dubrovnik Conference on Transition Economics, a former transition economy into the EU and into the Euro area. It has been a joy for me personally and an honor for my career to have had the opportunity to watch this progress over the last 3 decades. Being a generation older, I look at these past 3 decades with a certain paternal pride in what I've seen develop. Nevertheless, I'm concerned. I'm concerned that Boris will go off to Frankfurt without the watchful eye of the Dubrovnik Economic Conference seniors. And there are a few people in the room who've been here, who got to the Dubrovnik Conference before Boris made it. Marko Škreb, who left earlier this morning, was the governor at the time. He founded the conference with Mario Blecher, who was at the IMF at the time. Others who were there at the start included myself, Ricardo Lago, Evan Kraft, Jacob Frankel. Sandra, were you here at the very beginning? Oh, I'm sorry. Okay. We look at and we surviving senior members of the Dubrovnik Economic Community, Economic Conference community, are concerned that Boris will be going off to Frankfurt without having the benefit of our watchful eye to make sure he's doing the right thing. So we're concerned that he won't have all the tools he needs to conduct monetary policy. Perhaps you could open that up as I speak. And so with that in mind, we want to make sure that he has in his hands all the tools necessary for the appropriate conduct of monetary policy in the European Central Bank. So we wish him well and hope that he comes back to sort of keep it so we can keep an eye on him. What you see here are the basic rules of monetary policy, a set of dice.
Now we can go to the beach. Thank you very much.